Action. I don't think the macro matters just yet for this broader trade. I think we're still looking at tech names, and it is more of a sector story as opposed to a broader thematic.
I think how tech digests the news today, particularly in the States, is going to be really interesting. AMD, Apple under pressure again. That's 6% of the S&P. How does that translate? Do the European markets need to front run that a little bit? I think there's going to be some caution this morning. Anyway, here we go. European equity markets are about to open. We'll get a pretty good gauge as to what is happening in a few minutes. The early indications are that we're going to, again, at a headline level, I think, see a fairly cautious response. I think equity markets, I think until you get clarity on Powell, I think until you get clarity, I've got Super Tuesday coming up a little bit later on. Does Trump take the gloves off after that? You've got the AMD story, which kind of speaks to that narrative. You've got payrolls coming up on Friday. I think there's still the 3 Ps, as Sam was bringing us a little bit later, have still yet to fully reveal themselves.
Well, let's talk a little bit about this tech picture, though, because right out of the gates, if you look at the UK indices right here, you are going to see, you know what, we're going to put tech on hold for a second, because first you're seeing some of the commodity names take a hit, some of the banking names take a hit. Basically, your outperformers from yesterday are on the back burner today, which is, to your point, from a macro perspective, that sign of caution. But when we do talk about the tech story, you mentioned President Trump as well. This is why I think ASML is going to be so interesting. Yes, from the tech read-through that we get today, from the AMD story as well, but also because there is a sanctions battle right now happening between the United States and the Netherlands kind of caught in between the U.S. and China, and whether or not ASML is going to
There's clearly some China weakness in the market this morning. So if you look at it, the commodity stocks are broadly lower, but energy is actually kind of where the real hit's coming in terms of the point story. But I do see LVMH softer. I do see HSBC softer. Richemont is a little bit softer. ASML, to your point, is softer as well. So you are certainly seeing that weakness already in the market. Novo, the drug stocks, people are kind of looking for a bit of defensiveness this morning. So Novo, Sanofi, Novartis, Astra, GSK, all tracking higher.
It's a pretty defensive picture, isn't it? When you look at the best performing sectors, there are only 3 in positive territory this morning. Utilities is the top, and healthcare as well. So this is a very defensive picture. It's a stock market that screams pausing, waiting for a lot of macro events and a lot of other events to price in. So we've had the news out of China, we've got Powell speaking, we've got the jobs report at the end of this week, we've got plenty of other things, the Super Tuesday, State of the Union. There's a lot of ways things could move, and we seem as if we're sort of pausing this morning, pausing to the downside, down around 0.2% on stocks this morning.
But I'm curious how much kind of upside there can even be from here, and what that might look like. Is that something we get from the ECB if we're starting to see perhaps a little bit more of a wait-and-see approach, or even a more dovish Lagarde, as we've been talking about all morning? Is that what's going to pump up stocks a little bit more, or are European equities taking their gauge or taking their cue from Chinese stocks this morning, or from US
And does
stocks?
it all depend on your view on US tech, essentially? I mean, we had JP Morgan cautious around, you know, maybe things looking a bit bubbly on US tech. Goldman Sachs saying actually the rally's justified, fundamental support, these kind of values. So there's different views out there.
There's some key questions out there at the moment, aren't there? If you are in the market, do you de-risk at this point? Do you take profit? If you are out of the market and you're in one of those money market funds, do you get ready to buy the dip? Should you be positioning and getting kind of around that narrative? And I think it's a really different story on either side of the Atlantic at the moment, because it feels like the European economy is slowing down. We've just seen the French industrial data points to that sort of narrative. The story in the States feels different at the moment, doesn't it? Even Dr. Doom, Nouriel Roubini, is painting a positive picture as to what is happening here. Let's take a listen to what he had to tell us yesterday.
Talk about a soft landing, but there is serious possibility of what people refer to as a no landing, that growth remains above potential, and inflation remains sticky. Paradoxically, that good news on growth may be bad news for the market if that implies the Fed is not going to cut as much and as soon as people expect now.
Just I need to just take a moment there. Dr. Nouriel Roubini, Dr. Doom, sounding quite positive. If he's positive, maybe that's an indicator as well.
What did he have for breakfast?
Yeah, whatever it is, I want some. Anyway, he was obviously very gloomy going into the financial crisis. He certainly doesn't see that right now. Tessa Mann, Director of Multi-Asset Strategy at WTW, joining us now on set. Even Roubini sounds positive right now. Equity markets have taken off. They've had a really good run, particularly over in the United States, but here in Europe as well. You take a look at the numbers surrounding the DAX. If you're in, do you take profit? If you're out, do you get ready to buy the dip?
Yeah, I think that's a really important question for investors today. There's quite a myriad of factors that we're really seeing in markets. So on the one hand, earnings trajectories are still more in line with that type of soft landing type of narrative or potential scenario. There is an outcome in which we continue to see the consumer building in the US, and we can see that inflation coming down. So that could certainly happen. Another thing to draw out on the kind of upside case would be around, we do expect yields will come down. Those will need to come down as inflation comes down, even if we do not need to see more of that kind of monetary easing.
Why do you think yields are going to continue to come down? Because that was the trade going into this year. Why does it continue to be the trade right now? I listened to Raphael Bostic yesterday. Maybe we get a cut later on this year, then we get a pause.
Yeah.
The Fed's penciled in currently for three cuts this year. If we get to 2, is that good news or bad news for risk assets?
Yeah, good question. So even the Fed is indicating that obviously we need to look at the high-frequency data. That is indicating that inflation is possibly around target already. The key thing to mention is that real yields clearly will be elevated if we see inflation coming down and nominal yields not coming down. So more at that kind of longer end of the curve, we would see yields coming down. For your second question, for risk assets, we do have more of a kind of bumpy landing, middle of the road type scenario. For equities, so if we do see that kind of no-cut scenario, we would probably see a bit more volatility. What's really important, I think, for investors to consider is if we do get that kind of no-cut scenario, but it's backed up with that continuation of growth, that's not necessarily negative for risk assets. But,
so why things are, so it's the why we're pricing out the Fed rate cuts, I suppose, that matters, and the growth story is crucial to that. What about where the ECB sits in relation to the Fed, Tessa? Because we were discussing this in the last hour of the programme. For a long time, people thought, the ECB's not going to go first, but then that's getting into the conversation more and more as the US data shows its resilience and the European data continues to decline. What are you expecting to see? How much ahead of the Fed can the ECB go in terms of its rate cuts?
Yeah, certainly. The ECB, we could see more dovish policy. What I'm really looking at is the underlying fundamentals. So we know that that's been materially weaker in the Eurozone. Those PMIs, particularly on the manufacturing side, for some time have been weak. So we might see more dovish policy, but how that translates particularly into risk markets, I think we'll see less kind of interest rate sensitivity on the equity side, given the underlying weakness that we see in the Eurozone in particular.
Okay, and I wonder then where that leaves European stocks, because you point out in your notes that, European and UK equities are at historic discounts to the S&P 500. But if, and if the ECB cuts and if the euro weakens, that maybe helps some exporters, but maybe that's not the answer.
Yeah. Good question. If we did manage to see sufficient monetary easing and a rebound in the consumer, that could be certainly a positive impact on European equities. We've also seen actually, as we see kind of slight improvements at the margins on the Chinese consumer, that's had some beta to European equities given the kind of link with European goods. But certainly, European luxury goods in particular. We do see some balanced risks from here, though, both on the kind of European market and broader markets as well.
How much upside is there in terms of that potential Chinese consumer read-through? Is this something that has longevity when it comes to European equities, or is that still really an America story?
Yeah. We've seen a lot of weakness the extent of the weakness has been very challenging to call for international investors. What I look at from that kind of perspective is right now we're in a situation where the extent of the policy support that we get from Beijing is really imperative. And I think from an international investor perspective, that does lead us to more caution, as we saw with large net outflows from international investors into the market, Chinese market last year.
Is there a sensitivity to the cross-asset story here? Is there a sensitivity to the yields picture, a sensitivity to oil prices hitting a certain level? Are there certain red flags in other markets that you're watching for that have a read-through then to European equities?
Yeah. I think in equities, in Europe in particular, as I say, I would say there's a bit less sensitivity to kind of the yield picture, unless that's met with a real fundamental improvement. More broadly, if I'm looking at kind of global equities and US equities, if we do see kind of yields continuing to tick a little bit higher with upside inflation dynamics, and if that's kind of sustained for the next few months, that's a scenario that's much more negative, given earnings are not really pricing in, that potential downturn that we can see at this part of the cycle.
Tessa, we're going to leave it there. Nice to see you. Thanks for stopping by. Tessa
Great
Mann,
to be here.
WTW Director of Multi-Asset Strategy. Let's figure out what single stocks we need to be focusing on. Lizzie's got all the details.
Well, you were just discussing with Tessa, Guy, the read across of China into European equities, and you can see it at the open here. If we break down the stock 600 by sector, it's risk off today, all but two in the red. Bottom of the basket, basic resources, which of course has the most exposure to China. And if we just zoom in on some of the miners, you can actually see the impact on the likes of Anglo-American, Glencore, but it's also an impact on luxury. Look here, retail down 0.6% this morning. The likes of LVMH, Kering getting a knock this morning. Lukewarm response to those new targets and measures out of China. If we just have a look at some of the gainers on the stock 600 this morning, earlier I had mentioned Thales, the French aerospace and defence company. Of course, it had its results out this morning, and it does benefit from the war in Ukraine. It's up nearly 6% this morning. 5.78 is where we're at the moment. A strong year ahead, and already record sales recorded by Thales there. On the losers side, however, Bayer also reported results down 0.5% this morning. Its full-year earnings and a gloomy outlook. But it's another one in a stream of gloomy outlooks for Bayer. It's been a bit of a crisis after crisis situation for the German drug maker. Vivendi as well, lower 0.2% after it had to raise its bid for South Africa's multi-choice. Multi-choice shares, however, have risen 45% since February the 1st, when the deal was first discussed. Of Vivendi's Canal Plus to buy Africa's answer to Netflix, Showmax, which MultiChoice owns. There's some of the movers.
Lizzie, thanks very much. Lizzie Burden joining us there with the stocks on the move this morning, 12 minutes past 8 then, and European stocks are down by 0.2% this morning. Coming up, CEOs tell us they're more optimistic on the UK than they were a year ago. Just how bullish are they for Britain? We will look at that bullish case. That conversation next. This is Playback.
Formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and
beyond. It's a huge week in politics. Today, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, Thursday, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kayleigh Lines, and Bloomberg's top political analysts will bring you live global coverage of both events, starting at 9 p.m. Eastern. Bloomberg. Context changes everything.
We're very optimistic about the UK, especially in the long term. We're going to expand our exposure by about £10 billion. Digital, mixed-use property, infrastructure in general, energy transition, all great opportunities here in the UK. Can't get a longer-term value than the UK.
Australian Super's CEO Paul Schroeder on the UK, the bullish case for the UK perhaps. He was speaking to the team just yesterday. Nicely timed conversation because we've done a bit of research on this subject here at Bloomberg. The UK's reputation as a global investment destination hit rock bottom last April when Microsoft President Brad Smith said the European Union was a more attractive place to start a business. But 10 months later, FTSE 100 CEOs tell us confidence is recovering. Our Bloomberg radio anchor and colleague Caroline Hepker joins us now. She's spent the last 2 months sounding out Britain's business leaders, and she joins us on set this morning. Good morning, Caroline. And this joint piece of work, along with Bloomberg Economics and the Bloomberg Economic Reporting team as well. So what's changed? Is there sort of a more sensible view of Britain on the global stage right now?
Yeah, I think we're further away from the Liz Truss mini-budget disaster. I think we reached rock bottom really around April last year. So it wasn't just Brad Smith at Microsoft, it was Dyson, it was AstraZeneca, it was ARM going to the US. Since then, in those 10 months, though, there is more positivity in terms of the Windsor framework and the Mansion House reforms from government. And the 8 CEOs and chairs that we spoke to, all leading major businesses in the UK, do seem to be much more positive about the year ahead. It's not that things aren't difficult, but they are more optimistic about 2024. The WPP chief executive, Mark Reed, for example, saying that maybe this year is going to be the year where things start to get better, unlike 2023, where things only got worse. Have a listen in then to the Lloyds of London CEO John Neal, a snippet from our interview talking about financial services perhaps improving.
Yeah, we've seen a wealth of delisting on the FTSE. We've seen real challenges around investment and funding in the UK. We need to get that back on track. You know, part of the livelihood and well-being of UK PLC is as a global financial services centre.
So John Neal there, the CEO of Lloyd's of London, speaking to us for this in-depth reporting. I thought it was very interesting, though, that he was extremely pointed about what business needs, that is stability and a two-term government in his view.
Talk to us about the reasons behind some of this optimism, though. What are they pointing to at a time when global investors are saying, no, we don't want to touch that?
Yeah, look, inflation is coming down. You've got the possibility of interest rate cuts. Wages are going up, and they've gone up for the last 6 months. So the Marks and Spencer's chairman, Archie Norman, who was with us when we did a big deep dive about Britain being adrift last year, he came back to speak to us this time round. He was saying, look, people are genuinely better off. Bloomberg Economics sees a 1% a growth picture for the UK this year, but actually if consumers spend all of their savings, that benefit could be 1.9%. So those are some of the issues. Also, business investment in and of itself has gone up. And then there was a real view that the elections has seen a couple of centrists come forwards. They may not be competing on the exact same ground, but it is comparable, according to a number of the CEOs, including the Legal and General Investment Management CEO, Michelle Scrimgeour, who spoke to us too. Have a listen in then to the WPP CEO, Mark Reed. Again, another major boost for the services-based economy in the UK could well be artificial intelligence.
I think it's a massive opportunity for us. I mean, at one level you could say, well, the large language models, they're all being created in America. But actually, what you can do with AI is get access to these models extremely cheaply. Because we're a service-based economy, it could make our service structure much, much more productive, much, much more efficient. And I just think we have to lean into it and embrace it.
So that was Mark Reed, the WPP CEO. I mean, he said that it is making some of his employees, including the code writers, for example, 20 to 25% more efficient. Marks and Spencer's slightly scared me by talking about how artificial intelligence is going to be able to help them deal with consumers, track you through the store and deliver whatever it is that perhaps was missing from the shelves to you, and that they've got 300 data analysts, for example, integrating artificial intelligence. And so this could be a big boost for Britain. Even if we're not creating those large language models in the UK, they could actually help the services sector a great deal.
Is there an expectation, you brought up Liz Truss initially, is there an expectation now that we are going to see stability continuing even through the election? What is their view on what comes next were Labour to win? What's their view of Keir Starmer?
I think it is largely positive, and the CEOs that we spoke to were definitely speaking to both parties, and they were very pleased that politics was so focused on the economy, a consensus around growth, and that they did see both of these candidates as sort of largely managerial and competing on very similar ground, and wanting, after all of the Boris Johnson years, which weren't always that positive towards business, that there does seem to be a big change and that they're being included in the conversations. Having said that, we don't want to over-egg this. We also did an MLive Pulse survey to go with the piece on radio and on the Bloomberg terminal this morning, talking to 463 investors, and actually almost half of them say that they don't see UK living standards improving over the next 5 years. So there's a real kind of concern also about where the UK goes if it doesn't build on the positive momentum that we've seen in the past few months.
And that all factoring into the gap between investors and the business leaders you just walked through. How much worse could that gap get?
That is a really difficult question. I think that if we see follow through and we see more longevity in terms of policy making, for example, the British Land CEO Simon Carter, who spoke to me, the company has joined a Labour-led initiative to build Britain back in the next few months, along with a number of other businesses, including Vodafone, for example. So if you see those sorts of initiatives and more follow-through in terms of policy, maybe we can build on that momentum, and actually the gap will lessen between investors and business leaders in the UK.
Caroline, thanks very much. Thanks for joining us. Really stood out to me the role that real wages have played in this slight turnaround story, this uptick story perhaps. Bloomberg's Caroline Hepker from Bloomberg Radio with that deep dive. You can listen to more from Bloomberg Daybreak Europe, the podcast available to download now anywhere you normally get your podcasts. You get 45 minutes of content essentially around this theme, plenty more from some of those interviews that Caroline gave us a flavour of just a moment ago. We've got some data breaking on the European growth story, and this in Spain in particular. The composite PMI rising to 53.9. The forecast was 52, and that being driven by an uptick in services rising to 54.7. So once again, we're back to this theme that Southern Europe perhaps having a better slowdown than the North. I mean, not much of a slowdown based on that composite number.
Critty's about to go on vacation to Spain. I would see these data maybe potentially on the back of that getting better and better.
I think there's a real correlation between every time I book a piece of my trip and the data comes out hot.
This is just Spanish data.
Yes.
So basically, we should track you, then track the Spanish data.
I'm a
That's
big
the secret.
Yes, I'm a big
lead indicator
tourism consumer in that part of the world.
Okay. This sounds like quite the trip. Let's turn back to some of the corporate news that we are watching this morning. Bayer certainly front and centre. The company out this morning forecasting another difficult year of falling profit. This is the German company contends with low prices for agricultural products and more obviously on the competition front when it comes to its medicines. It is still clearly dealing with the fallout from the Monsanto story. There is a narrative that this is a company that needs to be broken up, but the company is pushing back on that today once again. I think it's basically got to fix itself before it can break itself up. Joining us now for more is Bloomberg's Tim Lowe. Tim, walk us through the read we've got from the numbers. There's a capital market day taking place today in London. It seems as if there is much more work to do before we maybe see a chink of light for this company in the future.
Absolutely. There was a lot of expectations leading up to today. It's been flagged. We reported back in January, probably not to expect some sort of a breakup, which some investors have been calling for years. And that's exactly what they came out and said. And they were pretty specific about pointing to some of the reasons why now is not a good time for that. The new CEO, Bill Anderson, did say, we're open to that potentially in the future, but right now is not the time. He highlighted 4 problems that he called kind of broken areas within the company that they need to address urgently. That's their high debt load. It's the legal problems that stem from the Monsanto takeover. Which both of those things are from that takeover. He also cited what he calls, too much bureaucracy within the company. That's a big thing of his goal to try to cut through. And finally, their 2 best-selling medicines are starting to lose their patent protection. So those 4 problems make it pretty challenging to consider how you can divvy up the company and get investors excited about investing in any pieces of those.
All right, Tim, I'm going to put you on the spot very quickly. How much of this is an idiosyncratic story relative to some sort of bigger Germany corporate read-through?
Yeah, that's a great question. The mood in corporate Germany has been pretty pessimistic, as I'm sure you're aware, in recent months. And Bayer's sort of maybe was a forerunner to that. They've had years now of just bad news and doomsday scenarios. So you could kind of call them a poster child for that. But one thing that I think that story misses is, a lot of German companies right now are, for value investors might look at it and say, hey, these are actually not bad companies. And frankly, they're kind of undervalued compared to companies based in the US or whatnot. Also, a lot of the really hallmark companies in Germany aren't publicly traded. So you're starting to see a lot more private.
Tim. Thank you very much. Tim Lowe joining us with the latest on Bayer and the German corporate landscape. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The deal?
The Deal. The Deal. That deal.
The deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Good morning, welcome back. 30 minutes into trading here in Europe. European equities, I think probably still one eye on what is happening in the States a little bit later on. Keep an eye on this Apple story, though. There was a big hit yesterday for Apple on the back of the EU fine that came out of Brussels. We'll talk about that in just a moment. But you've now got a story developing that Apple's sales are sharply lower in the first 6 weeks in China, which accounts for, let's call it circa 5% of revenue for Apple. So that's going to be potentially another big hit that we could see coming through this morning. So markets, I think, we've got a lot to digest. We're waiting for the main events of the week. Powell, payrolls, and tonight, Super Tuesday, politics.
Yes, absolutely. The 3 Ps, as we heard from BNP Paribas a little bit earlier on. Interesting on the markets, though, Guy, you referenced how we're waiting for what's happening in the US. We're watching the China Apple story. Also watching the China growth story on the back of the MPC and the mining sector, the worst performing today. As we've got some of the mining companies, Anglo-American, Rio Tinto, not down by a huge amount, but down by more than 1%, as if to underscore that, yes, there's the consumer story around Apple in China, and that's been problematic. But then there's also the construction story, and we know the difficulties that the property sector has had in China, and without any significant turnaround there, or even a line in the sand there, it's difficult.
Do you think the luxury stocks are reacting to the because luxury stocks are low this morning, do you think they're reacting to the MPC, or do you think they're reacting to the Apple story? Because in some ways you could argue that Apple is a luxury good, and maybe the read across, if Apple is down and there are reasons why Apple might be lower, then maybe you can read that across into other luxury stocks as well.
It's actually a really good point. It's one where you wouldn't actually tie Apple and likes of LVMH together necessarily. On the other hand, to macro this out even further, does the Chinese consumer even matter for the rest of the world? And I think that's something in terms of global growth that we've often said it doesn't. It did for a hot second, and then
I think
it doesn't.
Does to the luxury sector. And I think
but it's a very specific sector story as opposed to a global growth story, whereas the American consumer, for example, is a global growth story. But I think to be honest, I think they both factor, right? They're both negative weights.
Yeah, but I mean, still, your point is interesting, but still 5% growth out of China, out of an economy the size of China, is still a big number, isn't it, I suppose? We'll see how much of that comes through from the consumer side and whether we're really witnessing that moving up the value chain that China has talked about and is delivering on.
Yeah, and it comes, by the way, at a time when we're still talking about elections and what that might mean in 2025. These numbers look great right now, but with someone else in the Oval Office, everything could change. We've already heard some pretty big comments, some pretty big pieces, potentially 60% tariffs coming from Donald Trump, the front runner of the GOP at the moment. If he does go into office, what is the read-through into that Chinese economic story, which I think is a perfect way to dive into those details. Overnight, the U.S. Supreme Court saying that Donald Trump can appear on presidential ballots this November. It comes as, of course, we await Super Tuesday, the 15-state voting bonanza. I prefer Palooza, but that's fine. Where over a third of all delegates for the Republican nomination is up for grabs. Joining us now to explore that global perspective, Sudha David Wilp from the German Marshall Fund and Elizabeth O'Brien Ingelsson from the London School of Economics. Professor Ingelsson, let me start with you here. As we talk about the threat of tariffs and the threat of what a Trump or even a Biden presidency may look like for China, put this into some historical context for us. Do you see that deglobalization story of the last, I want to say, 4 to 8 years amplifying in 2025?
This is a story that unfortunately doesn't look like it's trending in a good direction. And one of the sort of lessons of the Trump victory in 2016 is the way in which change can happen quite suddenly. And you saw that with US-China policy. But undoing that is very, very difficult. And I think we will see, regardless of who wins in the White House at the end of this year, we will see that trend continuing.
Let me ask you about, if we do see a Trump presidency, Elizabeth, I mean, where does that take us on the Taiwan story? And will that be where everybody's attention falls?
I do think that that is the big question. I think that's the big picture question too. I think Trump has indicated that he has limited interest in protecting Taiwan. He has also indicated that he does see putting more tariffs, imposing more tariffs on China to be part of his widest sort of sweep of more tariffs more broadly. But despite that threat of tariffs on China, I do think for the most part, Xi will be seeing a Trump victory to be very much within his favor and very much putting into question the US policy of strategic ambiguity towards Taiwan, which had been really informing US policy since the 1970s. And so this question of what the United States does vis-a-vis Taiwan will be one to watch under a Trump, if it is a Trump presidency.
Sudha, let's talk about that if and what it ultimately means for Europe. Does Europe get caught and hit by a sort of double whammy were Trump to return to the White House? Not only would it be likely that potentially Donald Trump would, as we've just been hearing, target China, but he would also target Europe as well. But Europe relies on China too for much of its economic growth. What do you think the economic fallout would be for Europe when it comes to a second Trump term?
Certainly a second term for President Biden would be much easier on the Europeans, but there is a realization that President Trump could certainly make a comeback and return to the White House. And Europeans are seeing how, regardless of who's in the White House, domestic U.S. politics is having a profound effect on foreign policy. And because of security with regard to support of Ukraine and more assertive U.S. industrial policy and relations with China. And specifically when it comes to President Trump, I mean, talk of draconian tariffs would certainly affect Germany, for example. The German Economic Institute in Cologne just put out a report that's saying that over 4 years, Germany could see losses of about 120 billion euros.
So what does reciprocity look like from Europe? Is that even a conversation that's worth having when the United States is so large? What does the European response look like?
Well, I think Europe, thrives on open markets. The European single market itself is, a story about free trade within one territory. And Europe, and especially Germany, has based its economic growth model on exports. So, but if push comes to shove, I'm sure that Europe will take retaliatory measures. We will also see, obviously, the carbon border adjustment mechanism come into effect, and that is already going to be a thorn in the side of transatlantic relations.
Thinking about the defense story, Sudha, and how much that evolves, I wonder how much Germany is under pressure at the moment, how much are relations being tested between Germany and its allies, given the recent leaks of military conversations around long-range missiles for Ukraine that Russia made quite a lot of over the last few days. Giving us the German perspective, how much does Germany feel under pressure on that front, as well as, we've just been having a conversation in the last part of the program about how much is under pressure on the economic front?
Well, Germany has come a long way when it comes to military transformation since the full-scale invasion against Ukraine by Russia started. Military transformation is underway, but it's not enough because the German military has been underfunded and, you know, hasn't had support over the last couple of decades. And, you know, there's talk, of course, about boosting European defense capabilities, but Germany and other European countries have to put money into this sort of vision. Yep. And defense ministers are meeting today to talk about that. But even if Germany and the allies come together to move towards a defense or a military industrial market, it's going to take a while to catch up. Not only does it have to help Ukraine, Europe, but it also has to, you know, think about its own defense and deterrence.
2% is a floor, not a ceiling. Seems to be a line that I'm increasingly hearing. Elizabeth, let me come back to you. I'm wondering where the positives come in terms of European and US relations when it comes to China. Positives maybe is the wrong word to use here. One of the things that I certainly noticed out of the NPC overnight was news that China is going to continue to boost its EV production. China probably already produces too many EVs, and the fear is that it's likely to push a lot of those onto global markets. Do you think you're going to see, regardless of who is in the White House, some sort of commonality when it comes to the approach of pushing back on areas like EVs when it comes to resisting Chinese production and maybe fostering homegrown production? Do you think Europe and the US will see eye to eye on some of these issues?
I think, again, it will depend on who gets into the White House. Certainly under a second Biden administration, there are possibilities there. What you're describing, I think, is a normative thing. It would be fantastic if there could be transatlantic coordination on EV production and on strengthening the larger renewable capacity in both the United States and Europe. Whether that happens under a Biden administration is questionable, and whether it would happen under a Trump one is even, I think, more questionable. Trump himself has indicated that he will be coming into office with tariffs at the forefront of his policy-making decisions, including targeting Europe. So I think that it would be a long shot to be hoping for sort of coordination, as much as that may be necessary between the EU and United States on this issue.
Sudha, let's bring in what Professor Engelson was just talking about and apply it to the European story as well, specifically around EVs and the car story. We know the Inflation Reduction Act has been kind of a stalwart of Biden's policy. That may continue going into 2025 if he's reelected, but so might the steel tariffs that are still on the European Union. How different from a European perspective is a Biden presidency or a Biden 2.0 from a Trump 2.0?
Well, I think there hasn't really been a huge market difference between U.S. industrial policy between the first Trump administration and now Biden being in office. The difference is there is a format for dialogue. You know, Washington still talks to Brussels and other European capitals, and I think there is knowledge that Europeans and the United States have to work together on emerging technologies such as generative AI, quantum, biotech, and also, of course, you know, if they do want to, both the EU and the US want to move forward with a green transition, then it's also worthwhile thinking about how the two can work together on critical minerals, for example. So I do think there is still potential for cooperation, but it's obvious that both the United States and Europe are also, worried about populism backlashes among both their electorates.
Elizabeth, if Europe and the US should cooperate on technology, there's certainly a push to try and deprive China of some of the key technologies. We've been covering that story that we've referenced already around AMD and its ability to sell into China. How much can the US hold China back on the technology front? Or it's just a question of time, is it, before China catches up? Or how do you view that?
I mean, no one knows for sure, right? And this is one of the most important things to keep in mind. Particularly, I'm a historian. You know, the most important lesson of history is that nothing is inevitable. But certainly, the signs are pointing towards a China that is investing in its infrastructure, investing in its renewable capacity, in renewable energy capacity, not just with electric vehicles. And that, I think, ties into why there's a reluctance under Xi to fully embrace a stimulus that would be encouraging consumers within China, what you were speaking of earlier, and instead a real focus on the infrastructural capacity of China, which is a long-term shift. And if that long-term infrastructural investment is able to continue, and China is able to sort of ride the wave of significant economic troubles that it's in now, then some of those structural reforms that we're seeing this sort of the start of now may actually lead to a China that is able to dominate in most of the sectors of renewable energy. I do think that is a key space in which quite long-term structural change is starting to happen.
Elizabeth Ingelsson from the London School of Economics, Sir David Wilk from the German Marshall Fund. Both thank you very much indeed, setting us up nicely for our coverage of Super Tuesday, hosted by Joe Matthew. Kayleigh Lyons coming up a little bit later on. It starts at 9 p.m. New York time, right here on Bloomberg Television. I think the international response, I think everybody's really confused by what is happening here. We don't know yet who the candidates are likely to be. Does Donald Trump really deliver on those 60% tariffs? How does China respond to that? How does Europe respond to that? You brought that kind of question about reciprocity up. Last time Europe was cautious. I wonder whether this time Europe will be as cautious in terms of its response.
To me, I thought what was interesting is what Sula said, there's really no market difference between a Trump 2.0 and a Biden 2.0, even though we led with the idea that President Trump may come out of the gates swinging with tariffs. And she says, well, you know, the protection policies are not that different.
And I think that goes back to the aftermath of the first Trump presidency. There was, you know, between that and the handover into Biden, there wasn't as much of a rollback on China of China. Yeah, than people had expected. People had thought that this would be quite different, but during the Trump presidency, opinions in Washington had changed, had evolved, and there was more cross-aisle, agreement around China, wasn't there?
Yeah, and on the European Union as well, right? The tariffs that were put on from the Trump administration that stayed on to Biden, and then not to mention as well the idea that the only tariffs that were removed globally were the ones on the UK, and those were auto tariffs, and that's it.
What I think is really interesting is that Europe was completely blindsided by the IRA. The Inflation Reduction Act. Nobody saw the scale of that coming and the impact that it had in terms of the US economy. And Europe was sort of left scrambling around for a response, which I still don't think it's even got yet in terms of response to that.
They'll point you towards the Green New Deal, won't they? But the conversation ongoing there, and certainly the UK at first was saying, look, we can't compete in a sort of race to the bottom on subsidies, and that conversation evolves, as we know. Now, let's get to the Italian data. We're just getting composite PMIs coming through, 51.1, a little below the forecast, actually. The services PMI coming in at 42.2, so pretty much in line with...
52.2.
52.2, sorry.
42.2 would be slightly alarming.
A big story, yes, I apologise. 52.2 is exactly the numbers I see in front of me. The forecast was 52.3. I'm not sure we make much of those, but that's what we are. It's been a sort of mixed bag on the PMI.
At least it's positive. At least those numbers are positive. We continue to see positive numbers on the services side. Maybe Chrissy needs to take a holiday to Italy.
I'm sure that can be arranged. Yes, I'll single-handedly save Europe. That's where my entire paycheck is going, especially as maybe they're getting some funds from elsewhere. The European Union hitting Apple with a 1.8 billion euro fine over allegations that shut out music streaming rivals. We're going to bring you the details and the numbers next. This is Bloomberg.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
A lot to digest this morning. We're a little softer, but only a little. You've got the China story to digest this morning. You've got Apple to fold into that narrative as well. We're waiting for the Powell pivot. We're going to pivot to Powell, not the Powell pivot. And that's going to come a little bit later as well. We continue to get PMI data coming through. France's composite 48.1.
From the UK, and I'm the inventor of the gel razor, and today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I developed the all-in-one. The idea is you pressurise the handle. The gel flows through the reservoir up to the head of the razor, coating the blade, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I want it to succeed myself. Patented in the UK in 2021 September. With copyright protection, I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Technology technology. But besides that, let's talk about Apple shares. They actually did take quite a bit of a hit in New York after getting fined 1.8 billion euros because it doesn't just have a China problem, it has a Europe problem as well. This time, allegations coming out of the European Union that it shut out music streaming rivals like Spotify. EU competition chief Margaret Vestager, I think is how you say it, says Apple's rules ended up harming consumers.
The Commission found that Apple's rules result in withholding key information on prices and features of services from consumers. As such, they are neither necessary nor proportionate for the provision of the App Store on Apple's mobile devices.
Let's get more from Bloomberg's Oliver Crook, who's been covering the story. 1.8 billion euros, Ollie. Our producer Dan Curtis did the math. That's about 42 hours of revenue for Apple. How did the EU get to this number? Walk us through the math there.
Yeah, and it's also 0.5% of global sales for Apple, which is not a coincidence, I suspect. I mean, this is a sort of significant fine for a number of reasons. First time that the EU has gone after Apple. It's the third biggest fine ever given by the EU for anti-competitive measures, and it's quite a bit higher, Kriti, than we had anticipated. I mean, the reporting out on this that we had seen ahead of time was closer to 500 million, and we ended up with 1.84 billion. I go out to that decimal point because it's relevant in the actual breakdown of the fine, because there are two parts of the fine. There's the basic part of the fine, which is the usual arithmetic regulators use to determine when these violations have been done, how much they need to fine. Plus, on top of it, in this case, a lump sum that was put there because of how huge Apple is, and it needs to be an effective deterrent. The lump sum is 1.8 billion euros, meaning the core of the fine was only 40 million euros, which Vestager said was basically a parking ticket for Apple. So this needed to be big enough to discourage them from doing this again in the future. Of course, Apple is going to dispute this. They're going to appeal this. They say that there hasn't been damage to the consumer, that this is actually an industry and a sector that is doing extremely well, but it's certainly a warning shot from the EU and really from the Commission.
Yeah, really interesting that Apple is taking that tack, arguing that, there isn't enough proof of damage to the consumer, because in the future, under the Digital Markets Act, the EU won't necessarily need to prove that. Instead, it will just need to prove that one of 20 regulations, I think, has been broken by a tech business, and then damage to the consumer will be assumed. We are witnessing, with the Digital Markets Act, Ollie, a big change in the way Europe regulates.
Completely. And so while this particular fine against Apple was under Article 102, the Digital Markets Act is basically designed to go after exactly this kind of behavior. So what it does is it determines gatekeeper technology companies, companies that are so ubiquitous, so powerful that they have gatekeeper status. These are the Amazons, the Apples, these are the Alphabets, ByteDance, Meta, Microsoft, and it says what they can and cannot do. One of the things they cannot do is they can't favor their own services, they can't combine personal data across their different services, and they can't use third-party data to compete against third parties. So I don't know if you've noticed in the last couple of weeks here in Europe, when you Google flight destinations, Google Flights is no longer the top result. It's down further down. That is in compliance with this regulation, and you really should comply with this because the fines could be quite a bit larger. We're talking about the Apple fine, 0.5%. We're talking about fines of 10% potentially of sales and up to 20% if they're repeated offenses, which for Apple, for example, would be $76 billion. And of course, ultimately, it also gives them the tools to call for the breakup of these companies if there's a systemic problem.
I wonder how the different administrations that could potentially occupy the White House would react to such a fine and what the kind of response would look like on the political front. Ollie, thank you very much indeed. Ollie Crook joining us out of Brussels. Later today, Ollie is going to speak to the Commission's competition chief. Just heard from her there. Margaret Vestager is going to be joining a little bit later on. Make sure you stay tuned for that interview coming up a little bit later on. So we've done China. We need to factor in Apple. And then we're going to pivot to Powell.
Yep, and Super Tuesday, politics.
Super Tuesday, politics as well. Don't forget the other P.
Also in the mix.
We've got Powell testimony coming up. We've got the State of the Union address on Thursday. There's a lot to digest here. And, of course, payrolls on Friday. That does it for markets today. The Pulse is up next. This is Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Why should somebody want to be in the pharmaceutical industry? Why not go into something sexy like private equity?
In the end, what we do is we create these miracles that fit in the palm of your hand, these little medicines that can transform a human being's life.
This week, Bloomberg brings you the latest from China's annual National People's Congress, including China's budget plans, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Context changes everything. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. iPhone sales plunged 24% in China over the first 6 weeks of the year as Apple's troubles in the country deepen. China sets a growth target of around 5% that is described as ambitious as Premier Li acknowledges the challenges facing the world's second largest economy. Plus, the Supreme Court rules that Donald Trump can appear on the ballot in November. Ahead of Super Tuesday, we'll bring you the latest in the race for the White House. Also, a little bit later this hour, we speak to Hamdi Ulukaya, the founder and chief executive of Chobani, the best-selling yogurt brand in the U.S. He's spearheading a campaign along with 70 major firms, including Amazon, Bank of America, and Bloomberg, to connect, recruit, and train refugees in the workforce. Now, let's take a look at the European market map. A lot of the focus, of course, here in Europe is also what we'll hear from the testimony of Jay Powell. The other thing we watch for is Raphael Bostic, who also on the website and in a speech yesterday let understand that it's in the third quarter that he's expecting cuts, then followed by a pause, and he's worried about the exuberance possibly in the business community. Now, stocks edging a little bit lower. China's new targets have many questions from many analysts in terms of how much stimulus and support they'll bring together. And of course, it's I guess the market is now shifting from China to Jay Powell a little bit later on, and then the jobs report also later in the week. So Apple's iPhone sales in China declined by 24% over the first 6 weeks of the year, pushing it to fourth quarter among smartphone vendors in the country. That's according to the latest data from Counterpoint Research. Now, the California tech giant lost the title of China's best-selling smartphone maker to Chinese company Vivo, who appears to have done a better job of targeting the budget segment of the market. You can see Apple down 1%. To discuss Apple in China, let's get straight to Bloomberg's Oliver Crook in just a moment. But first, let's go to Beijing, where China has set its annual growth target of 5%, matching last year's figure, raising expectations of more stimulus. Bloomberg's chief North Asia correspondent, Stephen Engel, is following the story. So good morning to both of you. Stephen, how difficult will the target be to be achieved?
It will be difficult, and I'm saying that with good confidence because the Premier, Li Qiang, said the same thing. He said, it's not easy for us to reach these targets. We need policy support from all fronts. So there it is. But he didn't really lay out any specifics on what kind of stimulus that would be coming down the pipe because there are numerous headwinds, obviously, in the Chinese economy, be it property, which is ongoing, be it consumer confidence, and Oliver is going to talk about that, and the drop-off for Apple, obviously, big ticket consumer items have been falling all across the board on the consumer front, whether it's cars, refrigerators, obviously houses, but we'll get to that a little bit later. But there's also fiscal debt issues at the local government level. There is ongoing entrenched deflation across the board. So for Li Qiang, the Premier, to set the GDP target as the same target as previously a year ago is quite ambitious because of all those headwinds. And we all know that 2023 was not a pretty picture for the Chinese economy. They also set a target for 3% CPI. We're in deflation here. So they must be confident that they can reach that 5% growth target and 3% CPI. The big question and why the market's kind of reacted with a huh and a shrug is where's that stimulus going to come from?
Right. So, Stephen, my question is, how much stimulus are we actually expecting then?
Well, Xi Jinping, for one, has been steadfast in saying, and he said it 128 times in various speeches last year, he wants high-quality development. That essentially means they're going to sacrifice some GDP growth for more sustainable growth. But we don't know where that's going to come from because he is also launching and been launched right in the middle of a de-risking and de-leveraging campaign, in particular in property. We have not seen huge rescues of property developers. We have seen state support, though, and we saw it in the work report today in the tune of long-term, essentially central government-issued bonds to the tune of 1 trillion yuan. That will help bridge the fiscal gap because they also set the ratio from GDP to GDP, the budget deficit to GDP at just 3%. So that indicates they're not really willing to roll out large fiscal stimulus because they don't want to exacerbate those debt burdens at the local government level. So they're in a quandary, and they admit it fully that it's going to be a tough task. They need consumer confidence to come back. They need exports to rebound a little bit, but that's an external situation out of their control. But they don't want to exacerbate the debt problems.
Stephen, thank you so much. Our Stephen Engel, they're, of course, following this party conference very closely. Let's also talk Apple. iPhone sales in China declined by 24% over the first 6 weeks of the year, pushing it to the fourth among smartphone vendors in the country. That's according to the latest data from Counterpoint Research. Let's get straight to Ollie Crook. Ollie, is this an Apple story or a China story?
Yeah, well, invariably, it's going to be a bit of both, like so many companies on the planet. I mean, where I usually sit in Berlin, we talk about this with all the executives that sell massively into China, whether it's car makers or chips or all that sort of thing. Everyone's been talking about a rebound in the back half of the year for 2 years. It just has not come. And you see that weakness now. You see it in China, and you see it in the sales. I mean, down 24%, Francine, iPhone sales in just the first 6 weeks of the year is absolutely mammoth. This is the biggest smartphone market in the world. So there is yes, that question. And of course, Apple is selling a premium product. When you have a lot of competitors that have a much better price point, I mean, Apple has been eroding market share. They're down now to about 16% of the market share in China. They were at 19% last year, and they're losing more ground steadily. But overall, the overall market for smartphones was down also 7%. So there is definite weakness that is coming across the market.
So why did rivals in China, what did they do differently that actually did better than Apple?
Well, one of the main issues is going to be exactly that question of the premium. There are cheaper phones, but they're also very good phones, and there's also a huge amount of effort and energy in China to really get that tech independence and to sort of raise up its own producers of phones. So, for example, there's this question of patriotic buying, right? Huawei came out with this new phone that the state media was really touting, saying that this is really a great response to U.S. sort of tech and chip supremacy. And Huawei, in those 6 weeks, while everybody was down, their sales were up 64%, which is absolutely mammoth. And we should also say that this has sort of eclipsed the story, but for Apple, they have a problem in China. They've got a problem here in Brussels, too, with this huge fine that's coming down the pipeline. So these are all things to watch as Apple will face problems in China and more regulatory scrutiny here in Brussels.
Ollie, thanks so much. Oliver Crook there in Brussels. Now, later today, Oliver also speaks to the EU Commission's competition chief following that big news of Apple being fined. AMD said to have hit a U.S. government roadblock, meanwhile, while attempting to sell an AI chip tailored for the Chinese market. It's part of Washington's crackdown on the export of advanced technologies to the country. Bloomberg has learned AMD had hoped to gain a green light from the Commerce Department to sell the AI processor to Chinese customers. Now, the chip is said to have a lower performance than what AMD sells outside of China and was designed to meet U.S. exports restrictions. Now, to talk about all of this, we're also joined by Arnab Das, Global Market Strategist at Invesco Asset Management. Arnab, thank you so much for joining us. A lot of the focus, of course, is on China, on how a lot of the big conglomerates, actually sell to China, but also what the China consumer is looking at. How do you view China going forward?
Look, I think they've had a very different experience of the pandemic than the rest of the world, particularly the West, right? Here in the West, we had big fiscal transfers. China had a much more responsible approach to fiscal policy. And so ordinary people had to bear the burden of the lockdown, right? So they didn't have the kind of income effect that we all got from fiscal transfers. They had to bear a fall in the equity market, a fall in the real estate market. We had the opposite here, right? So we had positive income effect, positive wealth effect. We made out like bandits, right, during the pandemic. They had the opposite. So I think a large part of what's going on at the moment is kind of macro, right, is that consumers, households are still repairing their balance sheets and nursing their wounds from the pandemic and from the real estate market.
What does that mean for policies? So will policymakers really step in? I mean, we've been waiting for some kind of extra stimulus. I mean, there's a fragile real estate market. There's, as you say, also they're suffering from geopolitics between the U.S. and China.
Right. And I think a lot of these things will continue. They're sort of structural, right, like the geopolitical rivalry. There's also the demographic transition that China is already going through has been exacerbated, right, by the pandemic. So, look, I think there is some stimulus, and they are doing, some measures to accelerate growth. But I think they're taking a kind of responsible approach in a way, right? They don't want to have another debt binge, another kind of fiscally pushed credit binge that drives the real estate market or drives infrastructure right through the roof. I mean, so, one of your colleagues was saying how Xi Jinping wants higher quality, more sustainable growth. Right? I think that's right.
Will they get 5%? What do they need to do to actually achieve 5%?
Well, I think that's going to have to come, if they're going to hit 5%, it's an ambitious target, it's aspirational. If they get close to it, it'll be because productivity is rising rather than because of demographics or big increases in capital that are associated with debt. Right? So I think the question that we have to ask ourselves is, where is that productivity boom going to come from? And I think, they have in mind AI, they have in mind EVs, they have in mind, high tech of various kinds, green technology, and that can help. The question is whether it's big enough to move the needle enough to substitute for real estate and infrastructure. And I would say, it'll probably come in somewhere south of 5.
Interesting. Arnab, thanks so much. Arnab Das stays with us, and we'll have plenty more, of course, on China, and we'll talk Fed as well. Much more to come. We have a full roundup of markets. This is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, any given day it would be the head of a studio and, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Well, Raphael Bostic, the Atlanta Fed president, says he expects the Federal Reserve to cut interest rates once in the third quarter before pausing. His comments also come ahead of a testimony from the Fed chair, Jay Powell, who's set to appear at Congress tomorrow. We're now joined by Noor Al-Ali from our Markets Live team, and we continue the conversation with Arnab Das, Global Market Strategy at Invesco Asset Management. So thank you both for either sticking around or coming on. Arnab, when you look at the Fed, I mean, there's been, last year, markets, frankly, were all over the place. We were expecting a soft landing, a no landing, and they were kind of like zigzagging. Do you feel more confident that we have a clearer path that was communicated in what kind of inflation we'll get and what that means for the Fed?
Look, I think we're pretty much done with the tightening process. I guess they've put the idea, some of the FOMC members, and Larry Summers, of course, put the idea of another hike back on the table. We think that's quite unlikely. We're probably done. The real question is, how fast is inflation going to come down in order to let the Fed start cutting rates in order to maintain the real rate where it is and not have this kind of passive tightening, right? So I would say I think we're looking at that in the second half of the year. Maybe it feels a bit like waiting for Godot, right? Because we've been talking about this for a long time. But, you know, the flip side of that is that the growth resilience, right? The labor market is, as you know, right, very strong. The economy is strong. The consumer is strong. The economy overall is strong. There are pockets of weaknesses, and people talk about this kind of rolling recession. You know, we're in the kind of camp that says, you know, everybody tries to come up with a cliche, right? Ours is bumpy landing. Not a soft landing, not a hard landing, not even what Alan Blinder called a softish landing, but one that, like you said, has a lot of volatility, a lot of zigzagging, because, you know, the longer financial conditions remain easy and the longer the labor market remains tight, the higher for longer will prevail. And some stuff is going to start to come under pressure as that happens. Right?
And that, I mean, what do you see, Nora, as coming under pressure? I know there's a lot of chat about, you know, productivity, which could also change under some policies. We have a big election. Bitcoin was one of the things that people point at, certain Marco Colanovic of JP Morgan, as saying, look, this is a sign of frothiness in the market.
100%, right? And you've seen, you know, those risky assets come off the highs, you know, European futures into the morning, and as they've opened, and U.S. stock futures as well, Bitcoin as well, all have really kind of, you know, I don't want to say, you know, there's sort of a temporary pullback that you've seen. And dare I say, could it be, you know, on the back of that somewhat disappointing or lukewarm reception that investors had out of China, but also, you know, preparations for a potentially more hawkish than expected Powell later. And I think that's sort of feeding into that overall theme that perhaps, you know, that risk asset rally is going to take a breather. Now, momentum is very much there. You know, there aren't a lot of reasons that are stopping these stocks from rallying, even though we've had, you know, as you said, waiting for Godot is a very good kind of way to describe the idea that there's not much that's going to pull stocks lower, because all the momentum points to the fact that, you know, we're pretty much in the rally. We've had the Fed push back. Now, whether or not Powell kind of sets it up for a more hawkish setup could be quite interesting as well. And that's what we're seeing in the markets today.
What's the good news that's left in the economy, Arnab? And I guess this is the only question that markets should really ask themselves.
Well, I think you said it, productivity, right? I mean, we've had a resilient economy. We've had growth holding up, labor market holding up, inflation falling. Right? So the residual clearly is that productivity is rising. Some people even talking about a productivity boom. That may be overstating it. But it does seem that there's something structural changing in the U.S. economy. and maybe in the world as a whole, right? Partly as a result of the pandemic, partly as a result of the geopolitics, partly as a result of industrial policy. These are not things that are easy to get right? It's actually probably much easier to get them wrong if history is any guide. But I think the U.S. has done something here which is working, right? It may not be winning the election for Sleepy Joe, right? But it does seem to be working for the economy and for labor.
Arnab, do you worry that actually the economy overheats? And if there is a mismatch between, I guess, what President Biden has put in place, why are Americans not feeling it?
Well, I think there is a risk, but I think it's just a tail risk. I think the big picture here is that inflation is coming down, the labor market is tight, but wages are not taking off, right? So I think it's working generally very well. Why is it not working politically? Well, I think that's, sort of levels versus rates of change, right? We're all talking about how inflation is coming down, right? The rate of growth of prices is coming down. What people have been hit by is a big shock to real incomes and real wealth, right? They're feeling the level as being much higher of prices and other kinds of pressures that ordinary people feel. And of course, for ordinary people in the U.S., the margins are not very big, right? So I think I can sort of understand where the average Joe is coming from, right?
Yeah, and I don't know how this feeds into the markets, but of course we look at kind of the repercussions across the board.
100%. And to your point about the U.S. consumer, that resilience of the U.S. consumer has been something that's awfully noted, especially into tax season. That's why a lot of people say, well, you see that risk sentiment really pouring into those, riskier assets than normal. That's what's been driving, the tech gains. Of course, there's also that momentum of it, right? AI and its impact on the consumer and job habits and patterns have really changed the dynamics of the consumer today. And I think, we've had a lot of pessimism coming out of 2023 now, and there's so much of it that's been misplaced that I think the rally can continue into stocks. I'm the resident pessimist in my team, and I'm always the one that's looking for the contrarian view, but it's really hard for me to look at the data out there today and say, oh, that's going to be the thing that's going to drive us out there. But unless you get a steady stream of data that really points to that pain that you're talking about, there's no point for markets to stop rallying. At least that's what traders see.
That's what traders see until they're wrong. Thank you both for joining us. Noor Al-Ali from our Market Live team and Arnab Das, a global market strategist at Invesco Asset Management. Coming up, the most important day so far in the race for the White House has arrived. Yes, we're talking Super Tuesday. That's next, and this is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
From our our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Now, the U.S. Supreme Court says Donald Trump can appear on presidential ballots this November. The unanimous decision overturned a Colorado Supreme Court ruling barring him from running again due to his efforts to overturn his 2020 election loss. Now, it comes as Colorado and 14 other states hold primaries today on Super Tuesday, the biggest day so far in the 2024 race for the White House. Now, let's bring in Bloomberg's Kriti Gupta. Kriti, good morning. So was the Supreme Court decision a shock?
Good morning, Fran. It wasn't a shock in terms of the actual result. There's an expectation. There's so much momentum here for President Trump. It would have been a real shock if he hadn't been allowed to run. The shock comes in the fact that this was a unanimous decision at the end of the day. Both liberal and conservative justices both ultimately agreeing that this actually doesn't hold in court, but for different reasons, Fran. The liberals suggesting here that's actually a question of whether or not states even have the right to enforce the Constitution when at the end of the day it is a federal declaration, and that is a power that only Congress can do. Conservatives, on the other hand, saying that that's actually more of a story of whether or not Trump is actually criminally indicted at the end of the day. So again, two different takes on what it, but at the end, a unanimous ruling in that President Trump can actually run on the ballots. And if he does indeed need to be taken off the ballots, that's only something that Congress can enact.
Yeah, and Kriti, frankly, Donald Trump is expected to win big today. So what happens to his only challenger, Nikki Haley?
Well, that's going to be the question, right? Does she end up dropping out? Does she run as a third-party candidate? The issue with Nikki Haley is she has just so much donor backing, far more donor backing than President Trump has. And given the legal fees that have really amounted to him, he needs that donor backing. So it's not just about the 64-point margin of victory, by the way, that he has in the polls right now against Nikki Haley on a national basis. It's also about the fact that if Nikki Haley drops out after Super Tuesday, is he able to kind of scoop up some of the donors that she had? And does she actually endorse President Trump for the general election at a time when she's been very outspoken about really being the anti-Trump candidate, being the fiscal conservative candidate? On the other hand, you've got President Biden, for example, also trying to see if he has the backing of Democrats. Remember, in the Michigan primary, it was a great example of the fact that several people came out and said they were uncommitted simply as a protest of his foreign policy stance. Both could be longer-term trends in the general election, Fran.
Kriti, thanks so much. Kriti Gupta there with the very latest, of course, on the U.S. election. It's a big day, Super Tuesday. Stay with us for special coverage of Super Tuesday. That starts at 9 p.m. New York time, so it's middle of the night. I would still get up and watch it on Bloomberg TV. Coming up, we'll look at the launch of Tent UK, a partnership where leading companies commit to actively supporting refugees in their workforces.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly.
I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal. The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Now, iPhone sales plunged 24% in China over the first 6 weeks of this year as Apple's troubles in the country deepen. China sets a growth target of around 5% that it describes as ambitious as Premier Li acknowledges the challenges facing the world's second-largest economy. Plus, the Supreme Court rules that Donald Trump can appear on the ballot in November. Head of Super Tuesday will bring you the latest in the race for the White House. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, this week is also the launch of the 10th UK coalition, where leading companies commit to actively supporting refugees in their workforces. 70 firms are backing the initiative to connect, recruit, and train refugees, including Amazon, Bank of America, and us, Bloomberg. The Global 10 partnership is made up of more than 400 companies worldwide across different industries. Spearheading the campaign is Hamdi Ulukaya, the founder and chief executive of Chobani. Now, after moving to the United States, Hamdi launched Chobani in 2007, which became a billion-dollar brand and is today the best-selling yogurt in the U.S. Well, Hamdi Ulukaya joins us now. Thank you so much for joining us. This is an exciting day because it's also the launch of 10th UK. How did the initiative actually start? I mean, this is trying to give refugees a chance, but also economically to be financially independent. Have companies been forthcoming?
I have to say, when I launched it, it was in the back of Chobani's success, which I tried to dig in and find out what happened here. And in my journey, I realized that when we started Chobani from this old factory in upstate New York with few people, and as we grew and hired more, one of the most remarkable things that we've done after hiring everybody local is letting refugees who settle legally nearby towns to come and be part of Chobani. And the question was then, and same as what it is today, what are the obstacles for a refugee to be part of a job? It's just language, it's transportation, simple as it is, not having a driver license or cars, or not having the perfect right training for the job that is available, and the unknown. Who are these people, where they come from, what's going to happen? And I think job answers all of that stuff. And what happens the minute they get a job, that's the minute they stop being a refugee. And companies benefit from it, as Chobani did. And I credit most of the success of Chobani's as being diversified workforce, when everyone can come in and put their best to it.
But Hamdi, how important is it, for example, to do it? So I know you've had initiatives around the world. You started in the US, you had one in France, and now in the UK. I mean, the UK is a small, open economy with an extremely tight labor market.
Right.
How much of a difference could this make?
Well, here we are. This is the biggest launch that we had. We had Mexico, 50 of them. We had other countries. We are in 11 countries, 400, as you said, 400 multinational large companies. This is the biggest coalition that we launched to the date, which is 70 companies. Some of them are British iconic brands like BP and Pret, and some of them are, international, Marriott and Bloomberg. We have data that 20% of the companies, 10 or more employee companies, are having a shortage of labor. Can't fill it. And some numbers is over 1 million. We have 500,000 refugees here in UK. Half of them are Ukrainian, some of them are from Hong Kong, some of them from other countries, legally settled, ready to work, and having a hard time to find the jobs. So what Tent does is connect them together and share experiences globally. And we connect with HR departments of the companies and work tirelessly through the years. And our office here in UK in the service of companies to make sure that it's a success.
Hamdi, why do you think chief executives want to do this? Is this because they want to do good, because it's the right thing to do, or is it really to fill a vacuum in the workforce?
I think we call this win, 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 and it never ends. It continues to win. I mean, it's good for the refugees. It is the minute they're back to their life. Second, companies benefit from this dramatically. Culture, productivity, innovation, commitment for long-term, massive effect. But what you see is you get rewarded by the population. We did a study. In UK, most of the population rewards companies who are hiring refugees. And young talent want to join the companies who are hiring refugees and being part of this humanitarian crisis. So we have this global humanitarian crisis, but yet companies are leaning forward. Is really creating an environment for everyone to join and be part of the solution. In the end, companies who are leaning forward and doing right for business, doing right for humanity and community are the ones who are going to be relevant in near future and long time.
We speak to a lot of chief executives that say, look, it's actually harder, much harder to push a social agenda, to push a climate change agenda because of politics right now. Would you agree with that it's actually harder to be a chief executive that does good?
Yes, this is a big question, and I think no one questions this. Tomorrow's consumer are going to raise companies their pure purpose of to make money for their shareholders. That idea is an old idea, everybody knows it. Now, when you are for humanity and community and environment, these are not against the business or the success of business. The only question is you have to look at it, all dimension of the business to implement it truly, not just check the box, and you have to commit for a long time. And that is basically come down to the shareholders of these companies need to ask the CEOs to commit to these values for a long time. At Chobani, I would say we broke all the records. I'll all tie it back into commitment to humanity.
Do you worry? I mean, it's very difficult not to look at American television without talking about the U.S.-Mexico border, about I guess anger or even hate in certain cases, also in certain parts of Europe against immigrants. How does this end?
Well, the saddest part, and I'm a Kurd from Turkey, and I moved when I was 21 years old from Turkey to New York, and I didn't want to move, and I had to move. And I get a new life for myself, and I hope that I could create some better world surrounding me. Migration is a reality. It's going to be here. It'll be here for whether if it's not conflict, it's going to be famine. It's going to be environment, and it has been throughout the history, throughout the year. And every single study shows, and I'm talking about orderly migration, shows that the communities and companies and the cities and towns who welcome and create an environment for everyone to be part of, they get the benefit in the end. Innovation happens. I mean, look at this country. This country is in the backs of migrations, and it creates so much throughout the world, and is always leading. And that's a reality. Unfortunately, politics is politics. Yeah. And you look at the reality in the U.S. right after the last election and after politics, all the cities and the states that they know that how the refugees and illegal immigration does in their community, they want them in their towns and villages because always something new comes up. And it's a reality. Politics is going to happen, but we have to do what's right for the long term for people and for communities.
Hamdi, I also want to talk to you a little bit about Chobani, because a lot of people look at you as really, the poster child of a clever businessman that's made it in not that many years. You've also recently done an acquisition. So now you have coffee. Which,
I'm a coffee,
as an Italian, it really speaks to me, but how are you expecting that market to grow? And how do you expect the two to play? You know, yogurt and coffee.
Yeah, I think in the U.S., and I had an attempt in the UK, people don't know, I was talking to my driver as we're coming here. I tried to enter in this market. I ended up making it in Australia. We are number one in Australia. And one day I might come. I love this country. Food is an exciting place. Back to natural, back to good ingredients, especially post-pandemic, has been a reality. And, you know, ingredients, of course, accessibility, these are major things. So we built Chobani with very simple idea. Good food is filled with good ingredients and accessible price and available for all. And that idea worked. And now we're expanding. So we added oat milk, we added coffee creamers, which is, and designed in Italy, in Florence. My friends, they designed the packaging. And now we are adding coffee. I think the food and beverage is having the second spring, in my opinion.
But is it changing? I mean, we speak a lot, you know, also to Novo Nordisk because of Ozempic and some of these, you know, weight loss drugs.
Yeah.
What's the relationship going to be?
I think post-pandemic, people understood that food is extremely important, how they consume what they consume. I think it's hard to break it through because these companies are major, big companies. They've been around for a long time. For a startup to stay independent and break through it and disrupt a category like coffee. I mean, you're talking about ready-to-drink coffee in the U.S., the major brand, has got 43 grams of sugar. That's 13 sugar cubes in a bottle of coffee. I mean, that's just wrong. Real innovation, good innovation. That's what people bring with La Colombe is coffee that people drink cold now. Just like in Italy, you know, you have your espresso, but there's this new trend. 75% of the people, they consume their coffee cold, even in the wintertime, even in New York. But can it be wholesome ingredients, very little sugar, not too much, and can be a daily habit because 90% of population, adult population, drinks coffee almost every day. It's benefits that more and more coming out.
So by giving something that's a little bit more, I guess, fitness conscious, you think you'll get through. This is the way the trend is going.
Exactly, and you know, we are all busy during the day. You know, we are busy moms, busy dads, busy workers. You know, what is fueling you naturally? I think it's food, it's well-being, and it's surrounded, you know, with friends and family. These are all important, but stuff like food, we can make it better. We proved that Chobani. It's simple, without preservatives, something that we can name and pronounce the ingredients. Even myself, who I learn English later, it's extremely important. And I think it comes down to one simple thing, is maybe coffee doesn't apply to that, but any food as a CEO we make, if we don't serve to our children, our family, we shouldn't be serving to anybody else.
That's a good benchmark. How big do you want to grow? And actually, I know there was talk about a possible IPO.
Yes.
Is this something that's still on the cards?
Still in the card. We have not made that decision. Company is in a very healthy place. We grow double-digit volume and dollar, gain shares. It's pretty amazing what's happening at Chobani. I contribute to all the people that passionately work at the place. We have no pressure. Our employees are 10% owner of company, and I want them to get an access to the wealth that we have generated. And that would be a reason I would do it. And second is to grow this company further. I personally do believe I'm not big into, you know, making 3 to 6 billion. But as you grow, your impact grows, and you get to do more things, and it gives me a lot of smile. So we'll see. I mean, we have quite a bit of options. So one of them would be that.
Andrew, what do you attribute your success to?
People. I really, of course, America, upstate New York. Idaho. I mean, America is a magical place. But the people I work with every day, refugees, migrants, people come from all background and do the right thing. Everybody wants to do the right thing. And the business is a great environment for everyone to come and join and focus on the common goal. Make good food, build life around it, and make the world a better place. It's not work, it's just having fun.
I could talk to you for another hour, but we do have other news. Hamdi Lukaya there, the founder and chief executive of Chobani. Now, coming up, we talk geopolitics, and Gaza ceasefire talks stall as Israel delays sending negotiators until Hamas answers queries. We'll have the latest on the war next, and this is Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Well, hopes for a ceasefire in Gaza have been dampened as Israel delays sending a negotiator to Cairo for talks with Hamas. Now, Israel says it will not do so until Hamas provides a list of the Israeli hostages it intends to free in return for a pause in the fighting. Well, Bloomberg's EMEA news director, Rosalind Matheson, is here. So, Ros, where are we with the ceasefire talks?
Well, the ceasefire talks, as much as they are very much bogged down in Cairo. Israel has not, as you said, decided to send a delegation for now. There is a Hamas presence there. There are conversations going on, but it's very difficult to get any traction without Israel present. As you say, the major sticking point seems to be that Israel wants an update on the status of all its hostages inside Gaza, who they are, where they are, their health, and so on, before it agrees to have the proper conversation around a ceasefire. Hamas says that's too difficult at this point in time, and so we can't even get to the point where we've got people properly around a table having that conversation. We knew the talks had been bogged down for days. The question is there any kind of way through in the next few days? Is there a path forward before we get into Ramadan, into the Islamic holy month, the holy period, when Israel has indicated it might be prepared to go forward with its offensive inside Gaza? The real impetus is to get this ceasefire done before we get into Ramadan itself.
Ros, the U.S. says the situation in Gaza is simply intolerable. Israel denies that people are starving. How is that possible?
Well, what we've seen is a lot of photographic evidence that people are in quite desperate states inside Gaza. Of course, when you've got a war on, you've got a lot of people moving around quickly. You've got, people fighting. You've got aerial bombardment. There's a lot of disruption, and that just means that people's daily lives are affected no matter what. Their ability to access food, water, medicine, shelter, and so on, regardless of anything else. Israel's point is they say there is actually a decent food supply, water supply, and so on inside Gaza. They accuse Hamas of deliberately disrupting those supplies and not allowing people to be properly fed. International aid agencies, those who have some kind of look inside what's happening inside Gaza, say the situation is in fact very, very dire. Some aid is getting in, but it's not getting distributed well. Of course, we know they're now resorting to airdrops as well. It's very clear that there is a significant humanitarian problem going on inside Gaza, regardless of where the supplies are going at the moment.
Ros, more developments also in the Red Sea. What can you tell us about that?
Well, we know the Houthis say they've hit another ship in the Red Sea. Of course, they sank one, their first ship that sank recently after drifting for several weeks. So we know the Houthis are keeping up that campaign of targeting shipping in the Red Sea. It does seem to have tapered a bit, but it's enough that most ships are still opting to take the long way around. So they're achieving their goal, really, which is just to force shipping to make those major diversions. We also have reports that some undersea cables may have been damaged in the Red Sea. It's very unclear if that's due to Houthi action or perhaps a ship just dragging its anchor. But either way, again, how on earth you repair undersea cables at the moment in the Red Sea is a very difficult question. So again, further disruption for supply chains, possibly for the internet and so on, because of what's been happening in the Red Sea.
Ros, thank you so much. Ros Matheson there, head of our newsroom here in EMEA. Now, coming up, evidence that investment is returning to the UK as chief executives tell us they're more optimistic than a year ago. We'll be looking at the bullish case for Britain. That's next, and this is Bloomberg.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
Now, the UK's reputation as a global investment destination hit a low last April when Microsoft President Brad Smith said the European Union was a more attractive place to start a business. Yet, 10 months later, FTSE 100 chief executives tell us confidence is recovering. For all the talk of British decline, official figures actually suggest the UK remains the world's top investment destination after the US, trumping even China. Our Bloomberg radio anchor, Caroline Hepker, has been talking to Britain's business elite over the past 2 months, and she joins us now. Caroline, there's been some great reporting. You've been speaking basically to anyone who's anyone. So what's changed? Is sensible Britain back?
Well, perhaps. Last year, if you remember, it was pretty dismal for the UK. I think we did hit rock bottom in terms of sentiment. It wasn't just Brad Smith. Lots of other businesses were very critical of the business landscape in the UK, from Dyson to AstraZeneca, Arm listed in the US, if you recall. By the end of the year, though, the data and sentiment did seem to shift. And so Philip Aldrich and I did another sort of deep dive, Berenberg, Deutsche Bank economists were looking at the silver linings for the UK economy and asking whether there's actually a more bullish case to be made for the UK. So the WPP Chief Executive, Mark Reed, saying that actually this year could be one of those years where we feel a little bit better as the year progresses. We also had a lot of positivity from other CEOs. For example, the CEO of British Land, the Legal and General Investment Management CEO, Michelle Scrimgeour, and also the Lloyd's of London CEO, John Neal. He was saying that actually the insurance business is looking really positive. He was looking to the US, where most of their growth is, saying that there is a big business, that what we do here in London is really unique in terms of insurance. He was a bit more worried about financial services overall, but even he was saying that he does feel much more positive now. Have a listen to what he said.
Yeah, we've seen a wealth of delisting on the FTSE. We've seen real challenges around investment and funding in the UK. We need to get that back on track. You know, part of the livelihood and well-being of UK PLC is as a global financial services centre.
So that was John Neal, the CEO of Lloyd's of London, speaking to me. He was saying that the backdrop is better. He was more positive because of the government's Mansion House reforms, the Windsor framework when it comes to the UK's relationship with the EU. He does also, I think this is quite important, want to see a two-term government. So there is very much a realisation at the heart of business in the UK that we need policy making for the long term and, as Michelle Scrimgeour said, something that transcends government in terms of policy making.
So I wonder whether when you speak to chief executives, whether they think, look, actually the UK is a good house in a bad neighborhood because of everything that's going around the world, or whether they really think there's, you know, real progress.
Yeah, I think that's a big question, isn't it? I do think the positives are inflation is coming down. There could be an interest rate cut. Wages have been improving. For the past 6 months, we've seen wages gain. The Marks and Spencer's chairman, Archie Norman, who spoke to me last year when we did the reporting about Britain being adrift and uninvestable, came back to speak to us at the start of this year. And he was saying, look, people are genuinely better off. That's better for the M&S customer, but also that does signal that actually there may well be recovery. Business investment also went up last year, and longer term, there is more positivity about artificial intelligence. Maybe that could deliver big productivity gains for the UK. WPP CEO Mark Reed was saying they're already implementing it, and it's creating 20 to 25% greater productivity for some of their employees. Here's what he said about AI.
I think it's a massive opportunity for us. I mean, at one level you could say, well, the large language models, they're all being created in America. But actually, what you can do with AI is get access to these models extremely cheaply. Because we're a service-based economy, it could make our service structure much, much more productive, much, much more efficient. And I just think we have to lean into it and embrace it.
So that was the WPP CEO, Mark Reed. Look, there is a bit of a disconnect between business people and investors. We did an MLive Pulse survey on investors. Almost half of them think that the UK's living standards are going to go down in the next 5 years. Only 17% were positive. So there is still a bit of a disconnect, but some more optimism ahead of the budget.
Caroline, thanks so much. Caroline Hepker there from Bloomberg Radio. Up next, Bloomberg Brief, Danny Berger and Manus Krani in New York. We have a lot of news when it comes to Bitcoin, Super Tuesday, so U.S. politics, and of course, the Fed in China. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
This is Bloomberg.
Good morning from our world headquarters in New York. I'm Manus Cranny.
And I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
China sets ambitious growth goals that Premier Li says needs policy support from all fronts.
It's Super Tuesday, the biggest day so far in the race for the White House. More than a dozen states hold primaries today.
And bonds grapple with Bostic. The Fed official expects a pause after one rate cut in the third quarter. Flying kites on one and done. That has moved everything. Checking in on these equity markets. You'll take the bonds narrative. We saw a spike in yields. These equities are unsettled. It's Super Tuesday. We're dealing with what Bostic said. S&P futures are down by a third of 1%. Could it be the 1995 redox? One and done, and then a really long pause. Either way, JP Morgan are talking about froth building in this market. That's Kalanovic. And at the same time, you've got Mr. Matechka saying still overweight growth relative to value. A couple of stocks really for you to focus on this morning that are in focus. You have got Tesla down another 2% this morning. We'll talk about what that impact that is having on Elon Musk's wealth a little bit later on. Down 2.4%, down 7% yesterday. Magnificent Seven, could it turn into the famous five? Roll it over, have a look at Apple. Apple also under pressure. Sales in China down more than expected relative to the competition. Sales in China down 24%. So Apple is on the downside. NYCB, New York Community Bank, bounces. Although you got to say, after a nearly 50% drop in the space of 2 days, there's very little to save you there. And who's going to save China? It's going to be the policy response mechanism, 5% growth target. Li Qiang says that it's not going to be easy to hit these targets. However, Morgan Stanley say global funds are going back into China.
Back into China. Well, are we going back into yields? Certainly we are this morning. This is what we call a little bit of whipsaw. After those Bostic comments you mentioned yesterday, Manus, we saw Treasuries sell off. We went above 4.2%. Now we're back below 4.2%. But the one clear trend has been curve flattening. We've seen it on both sides of the Atlantic as we reprice just how many Fed cuts and how many ECB cuts we're going to get. Today marks 20 months of curve inversion. Since the curve inverted and stayed there, we are a couple weeks away from a record, not to mention, where's the recession? So what is this really telling us? Meanwhile, Bitcoin down 1.4%. We were so close to a new record, Manis. We were so close to 69,000. We didn't get there. We backed off the levels, but perhaps worryingly, things like those junky meme coins are also rallying. Something called Dog with a Hat, which is literally a logo of a dog wearing a hat, also set an all-time record. So maybe that's something to be worried about. But this is what Marko Kolanovic, as you said, Manis, was referring to, the froth that is building in this market, be it stocks or be it those meme coins. He wrote that investors may be assuming that the increase in yields is reflective of economic acceleration, but earnings projections for 2024 are coming down. And Manis, he says, the market appears too complacent on the cycle.
Well, his buddy, Mr. Matechka, over at the same shop says there's an unhealthy and high concentration in this narrow leadership, but it's going to stay for a while. But then you look at what David Costin is saying over at Goldman Sachs. We talked about this along with Peter Oppenheimer, who was with you and I just the other day, which is the Magnificent Seven has got fundamentals that garner the reason why you are there. This is not a redux that you saw in 2021, and it's not growth at any cost.
Right, and our next guest says that they have fortress balance sheets, and that's really important to keep in mind too. Let's bring her in. Joining us now is Nancy Tangler, CEO and CIO of Laffer Tangler Investments. Nancy, it was so great to see you. I should say you also wrote that they're chock-a-block full of cash, which I love. So would you be more on the David Costin side, that this rally, it is fundamental, this is not something that is necessarily froth building in the market?
I would, Danny. I've written for about 9 months that this market is analogous to the 1990s, and there are, most portfolio managers were born in the 1990s. I was actually managing money in the 90s, and there are so many similarities that demonstrate that stocks can coexist with higher interest rates. So the 10-year was about 5 to 7% during the decade. Inflation was about 3%. But we also had a labor shortage, and that is when companies spend on technology to improve productivity. And we are 3/4 in to pretty decent productivity numbers. And I think that these companies also are expanding margins. So we have trimmed back a lot of our tech and expanded in other sectors, but that doesn't mean we're not optimistic about tech.
So we've got to reflect. The last time you were with us, you said you're waiting for the moment to buy NVIDIA, but I am long the poor man's Broadcom. Sorry, the poor man's NVIDIA. So you had a little bit of Broadcom, but then I looked through and you've lightened up on your Broadcom. I want to know, first of all, did you buy any NVIDIA since we last saw you? And why have you lightened up on your Broadcom?
I'm going to take the fifth on the NVIDIA question.
That's correct.
Can't
blame you, Nancy. Was that a bit unfair, maybe? But anyway, listen.
No, listen, every valuation metric has its limitation. We use relative price to sales ratio, and NVIDIA is just too expensive. As a stock, though, I don't think it's expensive if you look at traditional metrics. But we commit to our clients that we're going to follow our discipline. We trimmed back Broadcom because in our 12 best ideas portfolio, it was a 13% weighting and had run a long way. We buy to 8 and we let it run. And then in our larger cap growth and equity income strategies, we own it there as well, and it just was way too overweighted. We also trimmed Palo Alto. We were lucky. It was before the 100-point drop-off. If I didn't have wash sale rules to contend with, I'd be buying back into Palo Alto now.
Okay. How are you feeling about Apple, Nancy? We learned that iPhone sales in China plunged 24% to start the year. The sell side is certainly turning against them. Evercore took them off their tactical outperform after their earnings. It's off of Goldman's conviction list. Do you like Apple?
We have a very modest position. We were buying it, as fast as we could in 2012, 13, 14, and we let it run and had to keep trimming it back, and then we started selling it. So portfolio manager speak, you trim when you want it back to your target guideline. You lower your guideline and start selling when you think the valuation is done. And so I wouldn't be chasing it here. I think it has to settle in. But conversely, we will be buying more Tesla as it continues to sort of sell off.
Can we ask you why? I mean, 7% drop yesterday, 2% drop this morning, having to pay money, essentially $1,000 to incentivize people in China via insurance incentives, price cuts. Why are you convinced that it is a buy the dip story for Tesla and not something more significant on the downside?
Well, I think that the stock only trades on EV news, Manis, and so that will probably continue. But I just had the opportunity to tour the Mega battery pack factory, and these are utility grade batteries that store power. That business is growing faster than the EV business. It's more profitable. They've vertically integrated it, and I don't think anybody's paying attention to that. Some estimates on Wall Street, it'll be more than double the EV business in the coming years. So I'm not buying it for the next 2 weeks. I'm buying it for the next 2 to 3 years. And we've been very disciplined. We initiated at 104 last January when the thing got clobbered, and then we've sold some because it got up to 240 or 250,
Lovely.
and now we're buying back in the 180s, and I'm comfortable with that for a longer term.
Well, Tesla is also one of these stocks of many that talk about their future AI potential. We know, again, Apple kind of has turned on that, going away from EVs into AI, but Tesla especially is one of these stocks that I do hear the argument that in the future, maybe even not 2 to 3 years, but in 10 years, this is going to be a big AI player. How much do you want to take that into account when you're analyzing whether or not the future cash flow is going to be coming from AI? And again, not just Tesla, but all of these companies who have that same narrative.
Yeah, I mean that's the difficulty in being an investor. You have to make certain assumptions, and I tell my team investing is about being mostly right. And if you're mostly right, you'll end up in the top quartile or the top decile or the top 1%, like we are in our equity income strategy. But you have to think about what is the market reacting to, and in the near term, the algos read the headlines. They see that the cuts in spending. The incentives in China, and they flee, and that's why the average hedge fund manager hasn't been able to beat the market.
Dennis just gave me a look because
he
knows that I love to defend the algos. He gave me a look when you said algos, like, well, Danny, it's your turn.
we do have this constant. It is a juxtaposition for the active manager versus the algos. You know, sometimes you're really pushing against a tide. And that was manifest, and I think you bring this really, really to the point with Amazon, which was, it was in certain ways overshadowed by Microsoft in the earnings, but you look deeper under the hood, and part of that is the cash on that balance sheet, the propensity to deliver more, apart from the fact that Bezos has taken over Elon in the #1 spot. But, you know, just extrapolate that for us in terms of the justification on Amazon.
Well, I mean, it's a free cash flow machine, and I think we'll begin to see that increase to about $100 billion annually in, I think, 2 years. So all of these companies are putting a floor under their stock, which is why I don't think you have to run for the exits with Apple, because they have announced they're just using cash on their balance sheet to buy back stock, and none of these companies have exposure to floating rate debt. And that's important because debt payments remain constant, but the income they're earning on their cash is going up quite dramatically.
You don't worry about this lack of innovation at Apple, that accusation of a lack of innovation at Apple. You're happy with the balance sheet over innovation?
I mean, it's our smallest holding. We tend to run really concentrated portfolios, right. and so, you know, if it bounces from here, we will continue to trim it and we'll be out of it at some point. But you know, it's a dance when you're managing a portfolio.
Nancy, can I just ask you one more thing related to, if I can bring it back to the algos, please.
Please
forgive me, Manus, but this idea, this is something David Einhorn has talked about, of all the price-insensitive players in this market. When you have the algos, you have passive investors. Jim Zeltner of Apollo has talked about this too, that it has fundamentally changed the market. Are those complaints real, or is it just a justification for underperforming?
The latter, I think. I mean, the hedge funds took over first after 9/11, and volatility increased dramatically. And that's when I started using the DeMark indicators offered on my Bloomberg terminal.
Good plug, Nancy.
Good plug, Nancy. No discount. No discount.
Oh, I know. But, you know, if you're a longer-term investor, volatility is your friend.
Right.
And so I'm not criticizing the algos, but they drive the short-term price movement. That's an opportunity for me to go in based on fundamentals and our valuation work and add to high-quality names that are getting punished for sometimes real reasons and sometimes not so real. But Tesla, you know, they've been compressing their margins voluntarily to take share. You know, I don't know what's going to happen in China, but there is a real security risk. You know, in China, they won't let anyone drive a Tesla within a certain parameter because of the software and the ability to hack. So we're going to probably do the same thing. And I think, you know, he'll be fine. Just pay attention to the mega battery packs.
Okay, and good to hear that you had first-hand experience there. And as you say, on the Mag 7, $190 billion of dividends will shore up this scenario. That is Nancy Tengler of Laffer Tengler Investments. Very clear thoughts. Other stories trending on your Bloomberg terminal this morning. This is what we've got for you. Israel is set to sell its first international bond in the public market since the war with Hamas. that erupted in October. The government is said to offer a dollar bond with tranches of 5, 10, and 30 years. The final terms, including the yield and the size, will be announced later today.
Now, speaking of Elon Musk, a bank group led by Morgan Stanley is said to have held talks with Musk to refinance the debt package that helped him take X private. Sources have told Bloomberg that talks to strengthen the $12.5 billion package faltered earlier this year after discussions of options such as reducing the cost of the debt.
Mark Cuban is backing President Biden ahead of the likely November rematch with Donald Trump. The billionaire entrepreneur and minority owner of the NBA's Dallas Mavericks visited the White House yesterday for a roundtable on drug prices. Cuban is urging Biden to go further to rein in prescription drug prices. Well, coming up this hour, it's a week fraught with politics. We'll get into Super Tuesday and the Middle Eastern tensions with our guest, Tina Fordham, founder of Fordham Global Foresight.
But first, China calls for policy support from all fronts as Beijing sets this year's growth targets. We're going to have more on that coming up shortly here on Bloomberg Brief.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show, now weekdays at 9 a.m. Hong Kong time, right here on Bloomberg. Context changes everything.
The main target for development this year are projected as follows. With GDP growth of around 5%, it is not easy for us to realize these targets. We need policy support and joint effort from all fronts.
That was the Chinese Premier Li Qiang delivering his first work report to the National Parliament for China's growth target. Bloomberg's Stephen Engel joins us now from Beijing. You are working a heck of a day. So this, how much drama was there in this? Certainly not as dramatic as some other gatherings that we've seen. The target, how robust is this 5% target, Stephen, and how achievable is it?
Well, there's not a lot of drama in these National People's Congress, and also, of course, the work report. It's been in the works for quite some time, and they're usually fairly scripted affairs. Now, we didn't have a much clue as far as what kind of policy direction would come out of it, and we still don't, other than they want to achieve around 5% GDP growth. That's the same target as last year, and we all know 2023 was a tough year for the Chinese economy. And now you have base effects for this year going into 2024, and also the same headwinds. In many cases, they've intensified. The property sector is still in trouble, obviously. Vanke is the latest developer. We're kind of some investors sounding the alarm bells on potential debt risks for China Vanke, which is the #2 biggest developer in China by sales, and one that is state-backed. So it's considered a bellwether. I'm going off on a tangent, but you can kind of see there are so many problems in the Chinese economy, and property woes lead to fiscal troubles at the local government level, and that's where this work report really concentrated on. They want to stimulate growth, no doubt. There's no question. But they don't want to exacerbate the debt problems by throwing a lot of fiscal stimulus at the problem. So they even admitted, Li Chang in that work report said, this is going to be a tough task to do around 5% GDP growth with all these headwinds facing the Chinese economy.
Okay, so they want to get the 5%. They've admitted it's tough. They need stimulus, but they don't want to over-stimulus. So what are they going to do, Stephen?
Right. Now, normally, we would have a press conference at the end of the NPC. That's tradition. The premier, Li Chang in this case, would give a press conference, and yes, they're highly scripted questions, but at least we could ask that question of him. Domestic, local reporters could ask him that question. Whether he answers it or not doesn't matter. But now, because I don't know why, they've decided not to do a press conference. It's the one chance in a year that we get to ask questions of the #2 man in China, and it's not going to happen this year. And that's going to add to more credibility issues, policy credibility, and also some of the concerns that international investors coming into China and pulling out of China are saying, listen, there's a vacuum as far as the communication, and we just don't know about the policy direction. So again, it's a great question. It's a question that needs to be answered. They're going to try and stimulate consumer demand. People are holding on to their money right now because they don't even believe that the economy is going to do better. Prices are falling. We've had 15 consecutive months of deflation at the factory gate. Prices keep on falling at the consumer level. So the confidence level, they have to boost confidence to help the economy, but they need a strong economy to boost confidence. Catch-22.
And then, exactly, but then you look at headlines. I'm just looking at one of the stories that we wrote recently. Don't invest in China. That's not me. That is Goldman Sachs Wealth Management, the CIO at Goldman Sachs Wealth Management. That's on the risk capital flows. But then, of course, FDI is incredibly important, and the lack of clarity around policy plays into that uncertainty. Was there an admission at any level of just how difficult it is to make the 5%, or what needs to go into the shotgun to get us there?
Yeah, there was. There was. He said there needs to be policy, from all fronts. Okay, and again, this is coming from the guy who helps direct policy, right? So you're going to need some fiscal leeway. You're going to need some monetary leeway and accommodation. We already had the loan prime rate, the 5-year loan prime rate cut a couple weeks ago or last week. That's one tied to mortgages. That could help the property market, but it's not the big bang stimulus, right? They're not throwing anything more than the kitchen sink. Well, they're not throwing the kitchen sink. I'm mixing metaphors. You know what I mean, though? They're not that big bang stimulus.
Yeah.
And that's what we're kind of all waiting for. That's why the markets were fairly muted today after this work report.
Yeah, fair enough. Whether it's the sink or the bazooka, certainly looking out for something there. Stephen, thank you very much. Stephen Engel joining us from Beijing. And Manus, as Stephen said, not a whole lot of reaction from these markets, although here's Aussie iron ore and CSI. Manus.
It is. I mean, look, Aussie dollar is the high beta play against China. If you don't believe in the 5% or the ability to deliver the 5%, Danny, we've got that down. It's the ambition to delivery gap, as they said, a 5% target, and they're going to need efforts from all fronts, as Stephen just said.
And then for the CSI, you have the divide between Goldman CIO for wealth saying, don't invest in China, versus Morgan Stanley saying the global funds, they're returning.
On the button, on the brief. We'll see you in a moment.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but this is, my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Bloomberg Brief. I'm Danny Berger with Manus Cranny in New York. So Manus, Elon Musk no longer the world's richest man after Tesla fell 7% yesterday, partially due to sales from shipping Shanghai. Shanghai shipments were the lowest in a year. He's now a measly $197.7 billion of wealth. Bezos is over $200 billion.
It's about closing that gap, isn't it? I mean, it's been a long time since Bezos has been on that top of that podium.
Yes.
And I just wonder, is there really that kind of rivalry between them in terms of who is number one and who
like
is
who
at
has the
top?
bigger yacht?
Yeah, who's got the bigger yacht? Well, certainly, look, Elon is under pressure. He slips off that title for the first time in 9 months. We just had a conversation with Nancy Tengler there, and as she said, she's a buyer of Tesla on these dips, and she's a buyer, and she believes in it as being a battery business, more so in the next couple of years.
Yes, because it is a market that trades off of any EV headline, and she says, pay attention to the batteries. Well, we're going to pay attention to the bonds. Stay with us.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, You probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar, something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
DOJ or other authorities
could face bigger challenges next.
Was going to keep reading World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
In the race for the White House, with more than a dozen states holding primaries today.
And bonds grapple with Bostic. The Fed officials expect a pause after just one rate cut in the third quarter.
We knew it would be a busy week. We've had just one Fed speaker, and already things are being shooken up.
Yeah, I mean,
happening.
it's Bostic. Is he flying the kite, as Waller did? We'll talk more about this, of one and done in the third quarter.
Yes, this idea, let me show you the markets and the reaction to it. This idea that we're going to have one cut in the third quarter and then a pause. Well, that certainly set bonds off yesterday. We did sell yesterday. We went above 4.2%, but this, folks, is what we call whiplash. This morning, we are down in yields 2 basis points, so we go back below 4.2%. But one of the consistent things has been curve flattening. Now, we're going back and forth between that this morning, but we are, there we go, flattening yet again. We are at a negative, just about negative 30 on your 2s, 10s. It's happening on both sides of the Atlantic. It is clear, at least for the time being, it is the front end that is having issues as we're pricing out those cuts from both the Fed and the ECB. Today marks 20 months of a curve, consistent curve inversion. Meanwhile, Bitcoin, it is down 0.8%. It just nearly hit an all-time record. And Manus, here's my other fun fact of the day. Dog whiff hat, a meme coin that is literally a dog wearing a tiny little hat, is trading at a record. So if that doesn't scare you, I don't know what will.
Dog whiff hat, that's got
no,
the
no,
real...
dog whiff.
Whiff hat. Well, there you go. That is the basis of ultimate investing. Look, the spike in yields that you talked about yesterday, to a certain extent, irked the equity market. But, you know, the bond market has been brought into line with the Fed's thinking. It wouldn't take much in these dots, Danny, to move the narrative down and push the consensus for rate cuts down to 55 basis points. S&P and NASDAQ both lower this morning, quite aggressively lower. Tesla was down 7% yesterday. We've fallen another 2% this morning. Again, there's concern about the overall production and sales in China. That knocks Elon Musk's wealth. We're also grappling with, if it is just one rate cut in 2024, what impact would it have on this equity market? JP Morgan, Kalanovic says there's froth building in the U.S. equity market, but yet his colleague Matejka says still wants to be overweight growth stocks. A couple of other stocks to keep an eye on. Apple lower as well on their sales in China. And then you've got NYCB managing to pick itself off the floor, so to speak, up 4.4%. That is after a near 50% collapse on Friday and Monday. Leave it to the Chinese. They're going for 5% growth, but it's going to take a heck of a lot of effort to actually get there. And for the flow show, policy from all fronts is going to have to be brought to bear. Morgan Stanley say global funds are returning to China. They are reducing their underweight.
Just to go back to those Bostic comments, Manus, because as you say, it's so clear that that is what has been moving the market over the past 12 hours or so. The idea is you just do one cut and then you say, we're going to pause, because you don't want to unleash this pent-up exuberance. But I go back to what Dale Cronk of Wells Fargo said on Bloomberg TV yesterday. What's the justification for cutting at all at that point? If it's clear the economy can handle 5% rates, why even cut once? If you're worried about this exuberance, what's the point of doing one and then pausing?
Well, the accusation is, one, they were so far behind in the hiking cycle that they were really, really behind the curve trying to grapple with the inflation. If you don't go for at least one indicative cut, it goes back to what Waller said. Had this conversation, you were there on the IB this morning with the swaps broker. Basically, it's 1995 redux. That's what Waller referred to just a couple of weeks ago. And here we are with Bostic reaffirming that. It's about carefully, moving carefully, and that means steepness are just hard to handle and carry.
Yep, which is so unfortunate because we came into this year saying this is the year of steepeners. This is when the
year
yield
of the
curve-
bomb.
Exactly. Didn't really play out so far.
No, not at all. The other big thing is, of course, it is Super Tuesday and the most important race for the US president so far. Tina Fordham is the founder of Fordham Global Foresight, and she says this: the Trump-Biden rematch is the base case with a contested convention for Democrats. Replacing Biden is highly unlikely, and Americans will choose between two candidates they don't like. We're joined now by Tina. Tina, good to see you.
Thank you for having me.
Welcome to the show. Two candidates that the American public don't want. What goes through my mind is, what is the risk of a materially lower voter turnout in that scenario? And that could be, this could be injurious actually to Trump relative to Biden.
Well, that's the irony of this situation, right? In my 2024 outlook, I called it inflection point, because in my advisory business, talking to global investors, the outcome of the US elections is their #1 risk. And to be frank, a return of Trump to the White House is perceived as the #1 risk outside of the US. So the stakes are incredibly high, but as you point out, you've got an American electorate which is exhausted by politics and unenthusiastic about what's on offer.
And to that point with Biden, I mean, Bloomberg and Morning Consult surveyed swing state voters, and they said he's too old. The swing states were more leaning towards Trump. You have this dialogue over that. You have this dialogue over Israel. If Biden wants to repeat 2020, where he has this coalition of voters, how difficult is that going to be for him at this stage?
So let's remember a few things, right? I call this PQ, your political quotient. This early in the race, Americans haven't made up their minds. We've already discussed that they're underwhelmed by the choices. Pollsters have an incredibly difficult job before them because there never have been so many variables, right? You have a candidate in Donald Trump who's the bookies' favorite and the pollsters' favorite, who is as likely to end up in jail as in the White House. And again, when you have exhausted, overwhelmed voters, US voters focusing on inflation, according to what the survey data tells us, less so on the points that you mentioned, how they choose and if they bother to turn up in a race where they're not feeling it, is a great big question.
You talk, I mean, you hit on a myriad of points there, one about the prospect about Donald Trump being in jail, but every time something happens in court, it seems to embolden his poll numbers, his base, etc. So just leave that for a moment, but you talk about an electorate that doesn't feel it. There is a great economy out there at the moment. Things are on fire. People have jobs. They're getting wage increases. That message is not successfully being translated, or as successfully as it could be translated by the Biden administration. What do they need to do, Tina, in your opinion, to convince the electorate that they have delivered economic success? Is talking about tax rises in State of the Union going to do that?
So it's a very unusual state of affairs. You're quite right to point it out, because let's face it, the metric that pollsters usually use when, sort of outlining what the prospects are is unemployment, growth rates, the so-called misery index, and everything in that respect should be supportive of the incumbent. It should be supportive of Biden. And yet it's really not. I'm not sure that we blame this on age. I'd bring it back maybe to the outlook for the Fed, as you talked about, where in economic circles, there's a lot of talk at the moment about maybe one of the big lessons from this recovery, such as it is that keeping unemployment, at relatively low levels, but with the inflation shock, seems to have dramatic political effects. Although I think this is a particularly American phenomenon. In other developed countries, I live in the UK, they don't expect the executive branch to be setting interest rates in effect and controlling price rises. That's what the Chinese, Communist Party does. It controls prices.
Does that mean then any hopes of Biden taking back control of the economic message is just not there? He's
Yes,
not
well,
going to be able to do that.
I think the narrative will change, put it that way. And in every election, as you get closer, when people don't start thinking about this until September. We're thinking about it. Investors are thinking about it. The rest of the world is thinking about it. Putin and Bibi Netanyahu are thinking they might get a better deal with a different occupant in the White House. Americans are going to see what happens with gas prices and with their grocery shop. There is a lag, a considerable lag, longer than I think investors appreciate before people start to feel better about things. Doesn't mean Biden will win. I just think that this is more competitive than it looks at this point.
You warn of uncertainty, multiple recounts. You warn of do not assume victory for Biden if it comes through in that way. My question to you is this. Do investors concern themselves that you could have a rerun of the kind of attack on the Capitol that we had previously? Is that a real material risk? What would that do to brand America?
Well, I think that backlash against the outcome of the elections is almost inevitable at some scale. Let's remember that markets didn't blink with the January 6th events, which is quite remarkable. It was still shocking, but there was very little discernible impact. And so there is still a prevailing sense that American institutions will resolve any difficulty. But, I talked to one very well-placed senior Democrat at a private event last night who said, they think that Trump will get on a plane if he loses because he needs to go somewhere where there's no U.S. extradition treaty. Now, these are just what people are talking about, right? This is not my forecast, but there have never been so many variables at play, both in terms of producing polling projections and weighting the variables, and the high likelihood of disputed outcomes at least dragging out a conclusion. So what I am saying is, if you're holding up your M&A transaction or other kinds of investments because you're waiting for a signal on November 6th, day after U.S. elections, better plan on a longer time horizon before there's resolution.
Right. Tina, I'm afraid we're going to have to leave it there. We really appreciate you coming in early for us. It's so fascinating. Tina Fordham of Fordham Global Foresight. Okay, Manus, some quick breaking news to get down to. The Times is reporting that Jeremy Hunt, tomorrow when he unveils his UK budget, he will be cutting national insurance by 2 percentage points. Just a quick check on these gilt yields. Not a lot of reaction, which is probably what the chancellor wants to see. These are basically the levels that before we got this Times report.
Yeah, I mean, this is about the tax burden in the United Kingdom. Rishi Sunak and Hunt have got to go to the polls with a different narrative in terms of the tax burden that they have levied on the United Kingdom. Economically, it's referred to as a stagnation nation. The pricing is, of course, that we had yesterday, our guest yesterday, talking about 5 rate cuts in the United Kingdom. But this is the breaking news in terms of what Jeremy Hunt may well deliver for the UK in the budget.
Yeah, and to that point, apparently Hunt and Sunak had decided against cutting income tax after the OBR said that it would significantly downgrade the amount of fiscal headroom. So you can see they're trying to do this careful balance of delivering what the voting population want without, upsetting the fiscal cart, as it were.
Exactly, and that fiscal headroom that they had in December was around £30 billion. That's now down to £12.8 billion. But that is your headline for the United Kingdom as we pivot from Super Tuesday to the budget in the UK, right here on Bloomberg.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
It's Bloomberg Brief. I'm Danny Berger alongside Manus Cranny in New York. So Manus, we've got some earnings on deck. Target is going to be reporting before the bell today. Investors, for their point, they want to know how the retailer is handling inflation and soft demand. Joining us to discuss is Bloomberg's Kimberly Adams. Kimberly, great to see you.
Good morning. Great to be here.
So we've already had some retailers out. I know we had, the Home Depot, the Lowe's, that DIY trend not looking so good. Can we extrapolate any of that into Target and what we're expecting for them today?
Pretty much the same. I mean, we know that despite strong holiday traffic, which is what Target had, Bloomberg Intelligence is expecting same-store sales are going to fall about 4.6%. And we know this is happening because consumers are pulling back. They're pulling back on spending. A lot of it has to do with credit card debt, school loans, things of that nature. So that's what they have.
What else do you think that the analysts are going to look at here? I mean, we saw a little bit from last week in Lowe's, along with, we've got a whole bid process going on with Macy's. But when it comes to running Target, what do you think it's going to be? Is it going to come down to the margins, or what are they going to focus on?
Right now, we have to remember, do you remember back last year, there was this huge thing with thefts across all stores?
Yes.
Target really suffered that a lot. They said it was organized theft. So as a result, they wound up closing a lot of stores across the nation. I think they closed 9 stores, that is, in 4 states. 1 in New York City, and the most, like 3 in the San Francisco Bay Area. So they want to see whether or not that's going to affect them and the bottom line. Target lost a lot of money as a result of these thefts. But this is a really, really smart company, and they know their client better than anybody. I mean, they are right now recreating themselves. They've got this really affordable consumer home line for like pots and pans and things of that nature. And my favorite, just like the Massimo line, they now have the DVF line, Diane von Furstenberg. You know, she's well known for that wrap dress. It was really big in the 70s and 80s and then had that resurgence with Sex and the City. So that's what we're going to see. We're going to see that coming out, and we're going to see more people in Target. So we'll see what happens.
I mean, you have all these stores saying that, like, shrinkage is the problem. You can't go to a Duane Reade and buy the most simple of things without getting them to unlock it. I mean, to some degree, combating theft that way, I mean, it has to be eating into sales even more. I mean, I wonder how much of the shrinkage problem is just an excuse for a lot of stores.
Think about it. This all happened in September, October, right? So we're going to see the results of that with these earnings and whether or not that affected the company in a really bad way. So we'll see.
Okay, Kimberly, thank you very much.
Thank you.
We'll bring those results to you a little bit later on in the day's program. Kimberly Adams setting up the Target results. Let's turn our attention back to China, because consumers there, well, they're not exactly engaging with Apple's iPhone. The sales of the nation plunged 24% in the first 6 weeks of this year. Customers turned to other smartphone brands. That's according to an independent research firm, Counterpoint Research. Stock falls pre-market, as you can see there. Apple down 1.5%. Let's get a little bit more on this story. Oliver Cook joins us now. So Oliver, look, this is not just an Apple problem, but let's focus in on that for the moment. Tim Cook has got to grapple with competition, an assault of competition on the Apple iPhone. Good morning.
That's right, Manus. I mean, there are two sides to this, right? There's the Apple question and then there's the China question. I mean, we're talking about sales drop of 24%, about a quarter in just 6 weeks at the beginning of the year. If those numbers are correct, that is obviously absolutely mammoth. And coming at a time when Apple is already struggling in China, they've lost a massive amount of market share. They were at 19% last year. They're at 16% now. They're now number 4 in China. And it comes as there is a lot of competition. As you're mentioning, there's a lot of cheaper options. There are a lot of very good phones, but there's also weakness across the Chinese economy. I mean, overall, for smartphones, it went down 7%, right? So that's not just an Apple story. However, Huawei was up 64%. So clearly, if you're doing it right, you can still gain market share. And it comes, again, at a time where China is really pushing forward their own tech champions, really wants tech autonomy, and there's going to be perhaps a bit of patriotic buying in there, something that Bloomberg has reported on in the past.
Well, if you think about the risks for tech companies in China, you've hit on two of them, the weak economy and competition. The other one, of course, Oliver, is regulation. This is something AMD is facing currently. Shares down 2.5% pre-market. What's the story there? They're trying to sell AI chips, but not getting approval from the Americans?
Yeah, as you can imagine, the U.S. is not actually too happy about that. So AMD, this has to do with one of their AI chips, and this is all from Bloomberg reporting, said to, according to people familiar with the matter. Basically, AMD came out and developed this other AI chip that is less powerful than the ones that they sell outside of the Chinese market in order to comply with U.S. regulations, in order to get it into the Chinese market. But we understand that the Commerce Department has said no dice. It's still too strong. You still need to make some changes, and in fact, you need to apply for a whole other different license in order to get these into China. So clearly getting more and more difficult at a time when we're seeing those tensions rise between the U.S. and China. I mean, the EV story the other day about Biden looking into those as smart devices. I mean, everything is a smart device.
You tune into Bloomberg Brief and you get everything that's smart. Oliver, let's just pause for a second and reflect, because Apple, I mean, the Europeans have taken a slice out of Apple yesterday. 1.8 billion euros of a fine. That's a heck of a message, isn't it, to the rest of Tech America, Tech Global, really, not just Tech America, but Tech Global in terms of the protective ring fence that Marguerite Vestager will build around Europe.
Completely, Manus. And really what's interesting about it is it's just kind of almost a firing shot of what is still to come. Let's deal first with this fine, right? 1.8 billion euros. Notable because it's the first time they've ever come after Apple. Also notable because it's the 3rd biggest fine they've ever given out for anti-competitive behavior. And notable because it's a lot higher than people had anticipated. People were talking about 500 million euros, but it also comes the same week, and this is the key point, Manus, where you have new regulation coming out in the next couple of days, hitting these major tech companies, all about anti-competition. It's called the Digital Markets Act, and it's all about these companies not being able to abuse their power. And Manus, if you think 1.8 billion is a lot, we're talking about they now have new tools to fine them up to 10% of their annual sales if they are infringing on this. If they do it repeatedly, 20%. So for Apple, that would mean 76 billion euro fines if they're in violation of this act, which comes into this week. And we'll talk to about it with the Competition Commissioner a little bit later today.
Yeah, looking forward to that, Oliver. We thank you for helping to make Bloomberg Brief a smart show for your smart devices. I don't know, working on a new tagline. Oliver Crook, thank you so much. And later today, as Oliver mentioned, he will be speaking to the EU Commission's competition chief following that news of Apple being fined. All right, coming up, we're going to take a look at some of the market-moving events for you to keep your eye on throughout the day here on Bloomberg.
names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
It's Bloomberg Brief, Danny Berger and Manus Cranny in New York. Let's get you set up for your trading day on this Tuesday. Here's what's ahead. We're going to have a slew of eco data. PMI comes out at 9:45 a.m. ISM then will come at 10 a.m. Eastern. Then Target, we have their fourth quarter earnings that will hit before the bell. And then voters head to the polls as more than a dozen states hold Republican and Democratic primaries today on Super Tuesday. Manus, happy Super Tuesday to you.
Well, it's going to be hectic tomorrow morning. We just had Tina Fordham, hadn't we, in terms of the risks of this Biden-Trump face-off or redux from a few years ago. These are the stocks that we're focusing in on. NYCB manages to just tick a little bit higher. I mean, it did trade the lowest level since 1996. You had a pair of downgrades from the credit rating agencies. By the way, that tanked 50% over the past couple of sessions. Tesla down 2.34%. Shipments in China under pressure. And Coinbase down, as you can see, a third of 1%. Users saw zero on their accounts yesterday. Technology problems?
Oof, yeah, that would be a scary moment. Manus, I wonder if we're heading for a scary moment for this bond market. We talked about this Bostic yesterday, saying that he sees a third quarter cut and then a pause, because he doesn't want that over-exuberance, that pent-up over-exuberance to hit the market.
Yep, there's the spike on the Bostic, one and done possibly. Takes you back to Jefferson just a couple of weeks ago, talked about this. So it's about moving carefully.
Moving carefully and moving the dots.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is that we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
We are starting to approach a little bit of euphoria here. The tailwind that's coming from easy financial conditions is really not surprising.
There's a begrudging acceptance in the investment community that this economy is really not nearly as fragile as people think.
The economy, because of AI and technology, might keep on growing. That's the biggest, actually, potential market surprise.
Maybe, just maybe, we could have stronger job growth with inflation coming down.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, equity futures negative here by 1/3. This is Bloomberg Surveillance with a focus on one thing: China, China, China. A new growth target is 5%. The government acknowledging the difficulty of hitting it. They need to hit it. If you're Tesla or Apple. Two stocks to look at this morning in the pre-market. Let's begin with Apple. This from Counterpoint Research. iPhone sales in China falling by a surprising 24%, Bramo, over the first 6 weeks of this year.
Two questions. One, how much is this weakness in China? And two, how much is this sort of nationalism around Huawei and going away from Apple phones? These are some of the big questions for both Apple and Tesla when you see the sales declines. How much is this something that is just sort of endemic of an economy that is slowing versus something that really goes to geopolitical tension?
Let's go through these numbers from Tesla together as well, Bramo. So Tesla had a really difficult session yesterday off the back of this. The numbers from the China Passenger Car Association. Shipments out of the Shanghai factory down 16% month on month. Lisa, year on year, down 19%. Terrible figures.
Which is the reason why you're seeing the shares down something like 2.2% in pre-market trading, 2.4% now. And just so far year to date, just to give you a sense, Tesla's down more than 50% from its peak in 2021. So yes, this is very much a China story. This is about demand. This is about demand for U.S. auto manufacturers. It's hard for them to hit that price point. They've been cutting prices in China. It's also, though, about the idea that the U.S. and China are moving further apart. You saw that with AMD. You saw that with this idea of regulatory issues that are going to get in the way of commerce.
Tesla is down by 24% this year alone, so we've lost a quarter of our market cap in a little more than, say, 2 months, which is just absolutely dreadful. That name is down by another 2% this morning in the pre-market. Lisa asking the right question. Take your pick, AMH. Is this about growth in China, or is this about rising nationalism?
I think it's a little bit about both. When you look at Apple, when it comes to Huawei, you saw when their new phone came out, a surge in people going out and buying them, even as Apple is cutting prices because of this patriotism. And this, to Lisa's point, is not going away. When you look at what AMD is trying to do, they created a chip that they thought the United States would give the green light. And the U.S., according to our reporting overnight, is saying not so fast. It's going to become much harder for companies to do business in China, regardless who wins the U.S. election in November.
The politics are complex. The economy is struggling. Look at this from the government. We need policy support and joint efforts from all fronts. Even they acknowledge, Bramo, that 5% growth target they've put out is going to be difficult to hit.
Because they don't want to increase the debt, which is the reason why people are kind of left with a lackluster feeling in markets. And oh yeah, guess what? They're also saying we welcome foreign investment in our manufacturing sector. Is that really going to be enough? Do you think anyone's going to say, okay, now I'm going to throw you a couple $2 billion because you said you want it, here you go. There hasn't been anything concrete from any of this, and that's why you don't feel a lot of enthusiasm this morning.
That's why you don't have a rally. We've got stocks down stateside on the S&P 500. We're negative here by a third of 1% on the S&P. Here's the state of play. Financial markets look a little something like this. In the bond market, a 10-year down 2 or 3 basis points, 4.1857. Bit of dollar strength out there, negative by 0.06% on the euro, 108.49. Coming up this hour this morning, great battle of BNP Paribas, with cracks growing among the Magnificent Seven. Matthew Bartlett of Derby Field Advisors as voters head to the polls for Super Tuesday, and Bloomberg's End the Current as Chinese officials set lofty goals at the National People's Congress. We begin with our top story this hour. Cracks continuing to form between the Magnificent Seven. Nvidia still climbing as Tesla and Apple are facing headwinds in China. Greg Bowdle of BNP Paribas saying this: tech is the part of the market with the best earnings forecast revisions, but we are worried about valuations and think there are ways to potentially hedge or diversify to help mitigate some of that risk. Greg, I'm pleased to say, is with us around the table for the next 30 minutes. Greg, good morning.
Good morning.
Let's just get to the Magnificent Seven, the fragmentation, the cracks we're starting to see form in this big group of stocks. What do you make of that? What's the signal?
Well, I think part of it is just that these are not homogenous stocks. So the real theme that's been the bullish catalyst for tech over the last 12 months or so has obviously been this emergence of Gen AI. So the stocks that are most geared to that have done incredibly well. But what we see is the Magnificent Seven. They're not homogenous. There are stocks there with different outlooks, different exposures, China being a key feature among some of them.
Let's get to that theme, China. Is that rising nationalism, or is that an economic growth slowdown? What is it?
I think the issue is it may be a couple of those things intertwined. I mean, you can look at the performance of domestic China equities over the last 12 to 18 months, and obviously that's been a very difficult market, so that points to something more domestically cyclical. But I think as we move forward this year towards the election, the idea of tariffs, trades, and deglobalization is going to be top of people's mind.
How much pushback do you get? You're basically giving this bearish message, gloom and doom. You got to be careful at a time when everybody else is going to the races. How much pushback do clients give you?
I think clients are cognizant of this. We've had some very strong performance from equities. I think most of the positioning metrics we look at are incredibly stretched. Valuations are incredibly stretched. But the news flow domestically in the US has been better. Growth data has been better. We've been in this kind of environment that you can describe as benign, disinflationary Goldilocks. People expect the Fed to cut. So it's this fine balance between this exuberance that's already priced in, high valuations, crowding, but potentially marginally better news flow.
The reason why I ask this is because if you think about some of these idiosyncratic stories, and I hate to use the I word, but I just did, Apple and Tesla, and they're dealing with some real issues, whether it's the smartphone cycle that seems to be slowing down, electric vehicles, sort of darlings are having some real issues. If you get some real downside risk to those stocks, how much could that be a catalyst to broader selling versus still sort of being in isolation?
I think it depends what happens elsewhere. So if you have this, as you say, idiosyncratic group of stocks that suffer from weakness, but you still have broad-based gains in the labor market, you have the AI story rumbling on in the background, I think there's enough positive catalysts to potentially keep the market going. But it certainly leaves the market more vulnerable. If you see the AI story just slowing a little bit, if you do see the data becoming either too hot or too cold, I think too hot is maybe the worry at the moment, then I think the fact that we have these cracks elsewhere is something that can leave the market more vulnerable.
So do you categorize this as a bubble?
It's always hard to characterize a bubble until it bursts, but I think we have some of those characteristics there. Valuations do look a little bit bubbly. Positioning looks a little bit bubbly. I think the thing which differentiates this to some prior bubbles is that the stocks that are leading the market here are very cash-generative stocks. So although valuations are elevated, the story has been who can monetize AI and who can generate cash from it. So I'm not sure if we're necessarily in a bubble, but we're in a point where we're seeing exuberance and very stretched valuations.
Lisa almost called you bearish, and you've got a price target of 51.50. I'm trying to make sense of that. 51.50 is bearish in this market.
100%.
I think that's a good characterization of where we are. I've called it exuberant earlier, and I think the idea that you get very modest positive returns is seen as bearish. I think that's kind of mindful of the market mindset at the moment.
So what are you seeing that other people aren't, that are upgrading their forecasts to 5,400, 5,500, that see the earnings revisions upwards, that talk about that better than expected economic growth?
I think I'm just seeing that it's already priced. So we had this pivot from the Fed in November and December. We saw a massive rally from the market. We have had better data. So we have taken our target higher this year as well. But we think we're following what's already been priced by the market. I think to look for an equity market that gives you materially higher returns for the rest of this year than you can get from the risk-free rate in the bond market is something that's going to require a real re-acceleration in earnings further than what's already priced by the market. The issue with that is if you get that, then at the same time you risk having some of these cuts that are still priced in from the Fed taken out of the market. So I think there's a little bit of a two-way pool that limits the right tail to the market.
This is a really important week, most important week since last week until next week, but I'm curious about what you're looking for in terms of the non-farm payrolls to sort of get a gauge of the latest on the labor market. Also on the elections, we're going to get into that next block, but I'm curious from your vantage point, what you think is going to be the most important event.
Yeah, so I think there's a lot of political noise this week, and the elections is obviously a big part of it. But the thing about elections is very difficult, maybe outside of trade in China, to position for that when there's a lot of water to come under the bridge in between now and November. Much more immediately, we have the payroll data and the CPI. And I think that's very important because what's been driving the market this year has been solid growth, but also the narrative of benign disinflation. So what we expect to get from the payrolls is a sequential cooling from the very hot print that we saw last month, but a still robust payroll print. In terms of CPI, the consensus is looking for a modest shift down, again, from the prior print. So those two things would be consistent with this benign disinflationary narrative that we're looking for. But I think the risks are asymmetric. If you were to have a print that is much too hot, then I think it creates risks for the market.
And a print that's soft, we're then in line for soft landing?
Yeah, I think that at the moment, there's asymmetry that we're more worried about overheating than we are worried about things being too cool. But you do have that symmetric, it's not necessarily a symmetric risk, but you do have the two tails of the risk. That if you see the growth decelerate too rapidly, then people start to worry a little bit about growth again. But at the moment, it feels like we're in that kind of sweet spot of benign disinflation and Goldilocks. But I think the risks in the very short term are if the data comes in too hot.
Nouriel Roubini, Volume 2. It's kind of what Nouriel said to us yesterday. The biggest risk up front right now is upside risk, and ultimately that's bad news for this stock market, right?
Well, essentially, if you get rates that stay higher for longer, then all of a sudden you get some sort of froth that's beaten out of the market. We've heard that from a number of people. What I struggle with here is we've seen a lot of companies be pretty rate insensitive. So at what point does the rate sensitivity kick in if we haven't seen it so far? And that, John, to me, is really one of the key questions is we really haven't seen it.
I found yesterday somewhat impressive was the fact that we were only down by 0.1%. Even though Apple was lower by 2.5 and Tesla was down by close to 7%. Weren't you impressed by that? We could sit here and say it's signs of exuberance, there's weakness under the surface, but at the end of the day, the fact that we're still near all-time highs and we've got Apple down from the highs of the year by about double digits now, the likes of Google haven't done well either. Tesla's been a quarter of its market cap has gone, and the fact is we're still near all-time highs.
Yeah, when you look at what the driver of that is, though, it's not because there's been broad-based support from the market, it's because there's been 4 or 5 stocks that have had absolutely exceptional returns. So I think it's a little bit less healthy than it looks.
Is that justified, though? This is what David Costin's getting into over at Goldman. Yes, okay, we can all sit here and say it's down to a handful of names, but are the valuations of those handful of names justified? Is it justified by the fundamentals?
So I think that the marginal moves that we see may be justified for the fundamentals. What I mean by that is the news flow we've seen from those stocks has been better this year. But the issue is some of the starting valuations are very elevated. So that what leaves us more vulnerable. And I think one of the things that we would question is whether the right way to play this very narrow rally is by the broad indices. Because if this is being driven by a handful of stocks and you have to have very high conviction about what that earnings path is out over the next decade or so, is the right thing to do to buy broad-based indices to reflect that? I think maybe not.
Greg Battle of BNP Paribas. Greg, you're going to stick with us. Equity futures right now, negative by a third of 1% on the S&P 500. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bloomberg has learned that Advanced Micro Devices has hit a U.S. government roadblock in attempting to sell an AI chip tailored for the Chinese market. Sources say AMD had hoped for a green light from the Commerce Department to sell the AI processor to Chinese customers, but U.S. officials told AMD the chip was still too powerful and the company must obtain further licenses. Elon Musk has lost his position at the top of the Bloomberg Billionaires Index. Tesla shares tumbled 7.2% yesterday. Now Jeff Bezos, the Amazon founder, is at the top with a net worth of more than $200 billion. Musk's fortune is $198 billion. The wealth gap between the pair was once as wide as $142 billion, but has now been shrinking, with Amazon more than doubling since 2022. Tesla, for its part, is down 50% from its 21 peak. The International Space Station has 4 new residents after the successful docking of SpaceX Dragon spacecraft. The 3 NASA astronauts and 1 Russian cosmonaut will oversee the arrival of 2 new rocket ships during their 6-month stay. Boeing's new Starliner capsule with test pilots is due to arrive in late April, while Sierra Space's Dream Chaser mini shuttle is due a month or 2 later. That's your Bloomberg Brief, John.
Hey, Danny, thank you. Up next on this program, Super Tuesday has arrived.
The poll numbers are very good. We're beating President Biden in almost every poll.
It is time for a new generational leader who can leave the negativity and the baggage behind and get to work for the American people.
Conversation coming up next, live from New York City this morning. Good morning.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Why should somebody want to be in the pharmaceutical industry? Why not go into something sexy like private equity?
In the end, what we do is we create these miracles that fit in the palm of your hand, these little medicines that can transform a human being's life.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley.
It's a huge week in politics. Today, it's Super Tuesday, and former President Trump is looking to cement his place as the Republican nominee. Then, Thursday, as the border, the economy, and the November elections dominate the headlines, President Biden will deliver his State of the Union address. Balance of Power's Joe Matthew, Kaylee Lines, and Bloomberg's top political analysts will bring you live global coverage of both events, starting at 9 p.m. Eastern. Bloomberg, context changes everything.
Stocks on the S&P 500 negative here. On the S&P, we're pulling back by around about 1/3 Yields are a little bit lower, down 3. Your yield on a 10-year, 4.18. Under surveillance this morning, Super Tuesday has arrived.
The poll numbers are very good. We're beating President Biden in almost every poll, whether it was the leading candidate or a candidate that was well down on the totem pole. You cannot take somebody out of a race. The voters can take the person out of the race very quickly.
We can do better than 2 80-year-old candidates for president. It is time for a new generational leader who can leave the negativity and the baggage behind and get to work for the American people.
Here's the latest this morning. The biggest day of the primary season set to begin with voters in 15 states heading to the polls in a pivotal point for the GOP nomination. Former President Donald Trump holding a wide lead over his last remaining challenger, Nikki Haley. A strong performance today may all but secure a Trump and Biden rematch. Joining us to discuss is Matthew Bartlett of Darby Field Advisors. Matt, my first question, and I know that this is difficult, but please define what success looks like tomorrow morning for Nikki Haley.
It is unclear what success will look like tomorrow morning. It will not be a good morning for Nikki Haley, but she might wait till November. And if Donald Trump loses, that could be success. So success could be, a future effort, an I told you so effort by Nikki Haley. But right now, it is very unclear. It is Super Tuesday, but this really is, like you just said, much more of a stress test for the general election between former President Trump and current President Biden. So this is, heading in that direction. I think this nomination will be wrapped up in about 2 weeks. Nikki Haley, again, she's looking to get the prize without the winning, and that might be sometime in the future.
Does she end up endorsing the former president when he, at some point later this month, actually clinches the nomination?
That's such a good question. It seems as if she does not have what it takes to get the GOP nomination, but it's quite possible that her voters are the ones that can unlock a general election win for either Trump or possibly Joe Biden. The notion that she just stated this week that she may not ultimately endorse Trump really leaves up to question, where do her voters go? And does Trump make an appeal for that? Does Biden make an appeal for them? That's actually what I'm looking for today. What are the margins? Can Nikki sneak one past the goalie in maybe Virginia, in maybe Vermont? And then what does her exit look like? And conversely, what does Trump's speech look like tonight? Does he try to graciously welcome her and her supporters, or does he go much more of the vicious, vitriolic, maybe even vile speech, like after New Hampshire?
She's raised $1 million so far, just in the first few days of March. She also raised still $12 million in February. It was down from the nearly $17 million in January, but she's still bringing in money. Does she just stay in this race to build a war chest for her future?
Listen, Anne-Marie, that's a good point. She outraised Donald Trump. Donald Trump right now has a cash crunch, maybe both personally and certainly politically. That is absolutely worth noting. Listen, Nikki has a set of supporters and also a set of donors. They like her message, they like what she's doing. Everyone knows that this is not headed towards the nomination in 2024 and maybe even in 2028. But nonetheless, they want her to soldier on, carry on, because they like the spirit of what she is doing. So it remains unclear how this ends, because it really is something of an illogical campaign right now. It is not a presidential campaign. It is much more of a messaging campaign. And right now, that message is important for her and her supporters.
Matt, when we're talking about basically getting to the general election, with about a third of all Republican voters today going to the primaries to vote, how much are we looking at actual potential policies from each presidential candidate, from both President Biden, but also from Trump, about what they plan to do with tariffs, for real, what they plan to do with immigration, for real, what their projection is for debt and tax cuts, all of these things that markets really care about?
Yeah, I mean, Brahma, that's like the key issue here. What does the future look like for President Biden, for President Trump, for the American people? What are the issues? Right now, it seems to be campaigns that are absent a lot of ideas, a lot of motivation right now. It tends to be very personal, whether it's Donald Trump looking for revenge or whether it's Joe Biden saying, I'm the only one that can beat Donald Trump again. So that is not a very compelling message. With the economy being the top issue on voters' minds, you would think both Trump, both Biden would be on surveillance, making their case to the street, to the American public on the most critical pressing issues at hand. Hopefully, we'll get much more substance as things develop.
You know what it's like, Matthew. No president, former or sitting, wants actual questions on American TV, but that's a conversation for another time. Matt, can you talk to me about policy on Thursday night when we hear from the president and we get the State of the Union address? What are the policy initiatives that he's going to lean on a little bit more aggressively?
Yeah, this is going to be the biggest speech President Biden has ever given in his life. This is going to set the tone, not just politically in Congress, but more importantly for the campaign trail. He needs to make sure that he can bring together the coalition that he had in 2020, make sure that left flank, which has been somewhat agitated in recent months, maybe over foreign policy issues, stays with him. He needs to reach out to middle America, to voters that may feel disenfranchised over inflation or economic angst. So he really needs to make a compelling argument as well as his performance. In a town that does not make anything, that hardly does anything, how you present has an outsized influence, whether you like it or not.
So true. And we appreciate the pitch for the interview as well. Matthew, thank you, sir. Matthew Bowler at Derby Field Advisors. Bramo, I know this is why you're frustrated, but on Thursday night is the opportunity to talk about policy. What kind of policy initiatives is the president going to discuss?
Honestly, what people are talking about right now is how long is he going to speak for? Will he present vigor? I mean, honestly, this is part of the problem.
Can he get through 60 minutes?
Can he get through 60 minutes? But this is what people are talking about. What I want to know about is, seriously, what are some of the economic projections? We talked about the Trump trade last time around. It was basically the market goes up. You've talked about this a lot, John. Can we repeat that? With a President Biden, what kind of goals are there with respect to the ongoing fiscal spending that's been supporting this economy? There are a lot of really key questions that affect this economy, and we're not talking about any of them.
The sequencing of Trump Volume 1, Greg Bowdle, it's your turn, I'm afraid, was to go tax cuts, then tariffs. Tax cuts, market off to the races. This time around, it feels like it might go tariffs and then tariffs. How do you set things up for clients when you start to discuss these issues?
So there's a couple of things. I think it's very difficult that we have a lot of noise this week, but much of this won't manifest until the back end of the year when we get a better idea of who might win, whether it's divided or united government, because that makes a big difference for things like fiscal policy. And I think that the reaction function now versus 2016 is going to be very different. You know, post-Trump's victory in 2016, what we saw were reflationary policies that were universally well received by the market. Even if we were to have a reflationary tailwind, is that as helpful for markets now when actually I've just cited earlier rates as potentially the biggest risk for equity markets? I think the thing that we're most focused on is tariffs, trade, and deglobalization. You already had a lot of China-related news flow at the top of the program, not related to the elections, but due to some of the issues that we're already seeing there from the likes of some of those more China-exposed Magnificent Seven. So I think tariffs, deglobalization, and trade will be the key feature for the election and for a lot of the rhetoric that we get running into November.
But Greg, whether or not it's Biden or Trump, there's going to be tariffs when it comes to China. But with Trump, it looks like it's going to be more aggressive. He's talking about, whether he does it or not, a 60% blanket tariffs potentially on imports. How do you even think of preparing for that?
So I think that the way that we've been talking about it is looking at the US names that we think are most exposed to this. So it's difficult because you have these crosswinds in China locally, where the China equity market has struggled, as I said earlier, for 12 to 18 months, and it's potentially, you know, I don't want to necessarily call a bullish inflection point here, but people are looking at it more closely. But the US names exposed to China have performed better. So that's something that we put in our outlook for 2024, that you can take US names exposed to China, short that basket, but potentially put that as either a short China trade by putting US domestic cyclicals against it, or you could actually put it as a bullish China trade by putting something locally in China against it as well.
Interesting. Greg, good to see you. Always is. Thank you, sir. Greg Battle, BNP Paribas, 51.50 year-end the price target. Bramo's calling that bearish. We closed yesterday at 51.30. Coming up next on this program, Bloomberg's Ender Current as China sets ambitious goals for growth. Can they hit them? We'll discuss next from New York City. This is Bloomberg.
formed a partnership with Penny Pritzker at some point to do parking. Is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really noodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
Jobs Day, and Bloomberg has the report under surveillance.
We've had unemployment sat at 4% for 2 consecutive years.
This is a two-sided sword. There is a softening in labor demand.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
This is a very strong labor market. The White House has got to love this.
This is something huge they want to run on.
Where is the slowdown?
If you look at the reality, it ain't showing that.
The February Jobs Report, Friday on Bloomberg.
Stocks pulling back here on the S&P. We're down by 1/3%. On the Nasdaq 100, we're negative by 0.6, snapping a 2-day winning streak in yesterday's session. Marginal losses down by 0.1%, even with the likes of Tesla down 7%. Apple struggling as well. Nvidia up by 3.5%. This is going to be a theme for us today, Lisa. Just the breakup of the Magnificent Seven.
We were talking about the Magnificent One, the Magnificent Four. It seems like Tesla already has dropped out. A lot of people have already kind of relegated that to the back of the room. But now Apple facing some real questions about China and the smartphone demand that doesn't dog the likes of Nvidia.
Let's turn to the bond market, push away from stocks just for a moment. We're down 2 basis points on a 2-year, 457.67. Before yesterday, 4 consecutive days of falling 2-year yields. Yields higher across the curve in yesterday's session, but this morning once again, we're lower. We're down by 2 basis points on a 2-year. Lisa down 3 basis points on a 10-year. ISM services a little bit later on today, just ahead of all that jobs data later in the week.
Yeah, 10 a.m. And we saw some weakness in services data that came last week. Last month rather. Do we see that continue? This is really going to be one of the keys for people who are looking for inflation. I will just say, one of the big questions underpinning all of our discussions is, at what point do bond markets matter for stocks? And do they, right? I mean, is this stock market sustainable even if rates go materially higher? It sort of depends on the day. It depends on the reason. It depends on the person you talk to. But fundamentally, that's really one of the key questions in 2024.
I'm not going to make a call. I won't offer an opinion, just an observation. We went from 4.1% January to 4.7% in the last week. Stock's still close to all-time highs. That's quite remarkable.
But that's, I think, the point, which is at what point does the Torsten Slok view of the world kind of take hold? Where maybe the Fed doesn't cut rates this year. Maybe you get rates that are higher. And guess what? Stocks could still gain. That, I think, is one of the potential outcomes people are looking at.
I think Marco Klanovic over at JP Morgan scratching his head about the same issue as well. We'll get to Marco's call later in the morning. Equity futures then slightly negative this morning. Just want to finish on the euro, 108.52, totally unchanged going into the ECB later this week. That meeting taking place on Thursday. Under surveillance this morning, NYCB levelling off after facing another plunge and a series of downgrades. Shares of the company falling to the lowest level since 1996, falling 26 and 23% over the last 2 trading days. Fitch Ratings cutting its assessment and Moody's lowering it even further into junk territory. The stock losing more than 2/3 of its value so far this year. Bramo, here's the good news if there is any, and I think this plays into the theme in the broader market. The ability of markets at the moment to compartmentalize issues, to say what's happening here doesn't have to influence what's happening there. JP Morgan again yesterday, closing at an all-time high. If you go back to the difficulties of last spring in March, the likes of JP Morgan was down 9%. I think for the financial system, there's a willingness, I would say almost encouraged by what happened last year, just to say it's an issue for them, it's not an issue for the others.
And it's a management issue as much as it is markets or a sort of broader economic issue. I think that is a huge signal, though, considering just how much of a sell-off and such a macro concern the banking issues were last spring. this does tell you that people are really looking past this.
And we have Jay Powell that's going to be on the Hill tomorrow, and he is going to be asked about this. This whole idea, Jonathan, you're talking about compartmentalization. Is that true when you have about 80% of these regional banks holding the commercial real estate loans? He's going to be grilled on whether or not he thinks this is idiosyncratic or not.
NYCB right now in the pre-market up by 3.5%. We've been going through the difficulties of Apple and Tesla. If you're just joining us, these are the headwinds they're facing in China. As we discuss more and more about the breakup in a bit, Mag 7, iPhone sales falling 24% over the first 6 weeks of this year. This according to Counterpoint Research. Tesla continuing its fall after posting a 16% drop month over month in shipments from China, according to data from the Passenger Car Association. We're talking about a name, Bramo, that's lost a quarter of its value year to date. Tesla down 24%. Apple, no longer the darling of this equity market in any way, shape or form. We're down 9% year to date.
And how much is this? And really, I think that it's really good that you started the show this way, which is, why is this happening? Is it because of China, or is it because of just a general slowdown in growth? Is it because of the geopolitics of the matter? And the issue is, we've seen the smartphone cycle kind of lag. We've seen the electric vehicle darlings really struggle with this question around adoption and how quickly they can be brought online. And then you add into that the sense of China doesn't want U.S. things being sold there. The U.S. doesn't want U.S. companies to sell certain technology to China. That really adding to the fact that China isn't growing. You put these things together, hard to get too excited about potential growth in the near term.
I think we're allowed to say all of the above. All three issues. One, growth in China. Two, the prospect of rising nationalism. And three, real sector-specific issues, smartphone industry, EVs, etc. We've seen so much bad news around the EV business over the last few weeks or so. On the number one issue, growth in China, they've got some lofty ambitions, let's put it that way. 5% growth target coming from the National People's Congress. The ambitious goal, that ambitious goal matching that of last year, but the economy is now facing deflation alongside a deepening property slump. Defense spending also set to gain 7%, so that's the most in 5 years. Enda Curran's joining us now to break some of this down. Bloomberg's very own out of Washington, D.C. Enda, can we get into the goal itself? How difficult will it be to hit 5% this year?
It's obviously going to be hard. Premier Lee said that himself in the speech, John, last night. He said it's going to be tough. It's going to require support on all fronts. They're talking about around 5%. That's hard because of the base effect compared to last year, of course. It's hard because China is stuck in its worst streak of deflation since the late 1990s, since around the Asia financial crisis. And it's hard because we know they have not turned the corner on the housing crisis. Sentiment there remains in the doldrums. Now, it does suggest that the government is going to have to borrow and spend more. There was some commentary in the report about central government bonds of around 139 billion. Some economists are seizing on that and suggesting that that means the authorities will be willing to put their money where their mouth is. But the overall tone of the report is still kind of along the lines of fiscal discipline. So it's an ambitious target. It's going to be a hard target to hit. But if China does pull that off, and if this is a year of the turnaround for the economy there, then that, of course, would be an important growth driver for the global economy. Remember, it's been all about U.S. outperformance with China in the doldrums. This would reverse at least some of that.
And how? How can they achieve this without adding to the debt? I mean, saying to people, look, we welcome foreign investments in our industrial sector doesn't really work when you have people who have been burned time and again internationally. What's going to actually drive some growth if it's not going to be leverage fueled?
Yeah, and markets themselves don't seem to be especially convinced by this, judging by the reaction, Lisa. And of course, by the way, the subplot in terms of the cancelled press conference by Premier Lee, that doesn't speak to transparency and confidence in China's economy either. But it's still a pretty ambitious growth target, and when the government sets it, typically they will ensure that it is met. And that's why I mentioned this point about the special central government bonds that they're talking about, 139 billion, worth keeping an eye on that. The fiscal deficit was set at 3% for this year, but of course they may have some flexibility. They could adjust that as the year goes on. So there are some suggestions that they will be willing to borrow and try and hit this. Now, interestingly, the statement, for the first time in several years, did not say that houses are for living in, they are not for speculating. That might suggest they're planning to take some pressure off the real estate, off the property developer side of things. And of course, if they can get a turnaround on housing, then you will see a broader lift in the rest of the economy too.
Edna, that Xi mantra has been in the report since 2019, so it does seem like this is a big shift. What can they do in terms of shoring up the property sector?
Well, they've been taken these kind of piecemeal decisions throughout all of last year to try and make it easier for, say, property developers to get financing, easier for them to develop their projects. They've brought down the cost of borrowing, the cost of mortgages for those who are buying these apartments off these developers. So they've been taking these piecemeal steps, but none of it so far has turned it around. And that's why some people are saying perhaps now by dropping this line about the property market isn't for speculation, maybe they're going to take even more steps this year. And you know, that goes to the kernel of China's slowdown. It's all about the real estate slump. It makes up maybe 20-25% of the economy. You can imagine the multiplier effect that goes with that. If they can turn that around, that then will have consequences for commodity markets, and that then will lift the broader China story, and I think will have spillover effects globally too.
They're also going to be increasing their defense target, 7.2% in 2024, most in 5 years. What should we take when it comes to this figure? Yes, it's an increase, but we do know that China has been fighting a ton of corruption within their military spending.
Yeah, look, I think it speaks to, they have been increasing it steadily over the years. I think it just speaks to the whole geopolitical security story right now. Defense spending is back on the agenda everywhere, Anne-Marie. As you know, China is no different. They have been developing and beefing up investment in their defense forces for several years. And I would imagine they're looking ahead to the US election later this year, where potentially, you know, at the very least, the current administration has maintained a hawkish stance towards China. If it changes government towards the end of the year, that could double down in a hawkish stance towards China. They're watching what's going on in other parts of the world, the Middle East and Ukraine. I think it just fits the whole narrative of defense spending and geopolitics globally.
And before we run, if that's going to be the case, if we get a more hawkish approach to China, I want to talk about the blowback to US companies. Are we seeing signs of nationalism start to hit Apple in a more profound way, start to hit Tesla in a bigger way? Is that just a subtle shift that we're starting to witness that becomes a bigger shift over the next 12 months?
I mean, it could be. I mean, don't forget, John, on the one hand, the Chinese government keep preaching that they're open for business, they want foreign investment, and they do want foreign investment after FDI turned negative for last year, after portfolio flows fled the country. They absolutely do, but of course, to your point, on the ground, we see action speaking louder than words. For example, those raids on various US companies last year hasn't done anything to inspire confidence. So I would say it's still pretty fragile sentiment for US companies operating in China this side of the election and after.
And a thank you, sir. And a Karen there of Bloomberg down in Washington, D.C. Speaking of inspiring confidence, check out Target in the pre-market, up by more than 6%. These numbers inspire confidence. EPS 298, the estimate, Bramo, 240, saying all the right things about the fourth quarter. I think inventory coming down much bigger, in a much bigger way than expected as well.
Yeah, and when they talk about the full year forecast for earnings per share this year, 860 to 960 versus the estimate of 912. When you dig beneath the surface, though, what I find interesting is they confirmed Bloomberg's previous reporting that it plans to go up against Walmart Plus and some of these membership programs that have online benefits. It also talked about upgrading its fleet of stores, and guess what? Creating more shops like Ulta Beauty. Everyone is sort of banking on the fact that 13-year-old girls have 15 facials that they do every single night. I'm just saying, that seems to be
That's what
the new
Target's
trend.
leaning into.
100%.
That's why the stock is up by 6% in the pre-market.
We saw the same thing with Macy's. They're all going to try to cash in on the Sephora gold mine that seems to be happening right now.
Better numbers and inventory's lower. I won't lean into that. The stock is higher in the pre-market by a little more than 6%. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. It's the biggest day on the presidential primary calendar. 15 states and 1 territory head to the polls for Super Tuesday. Former President Donald Trump is expected to win a majority of the Republican delegates. He picked up 29 more last night in North Dakota, sweeping the caucuses with 84% of the vote versus Nikki Haley's 14%. Activist investor Nelson Peltz wants to, quote, restore the magic at Disney. His Triumph Fund Management published a 133-page white paper ahead of the AGM. It suggests a partner for Disney's traditional TV channels, a review of studio operations, and a succession plan for CEO Bob Iger. A group formed by Tran holds about $3.5 billion in Disney stock, and they're seeking an overhaul of the board. Bitcoin's price is nearing an all-time high, driven by continued demand for those new U.S. spot Bitcoin ETFs and a looming halving. The ETF has attracted almost $8 billion of net inflows since debuting in January. Bitcoin's market cap touched $1.35 trillion, beating its peak in 2021. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Staggering numbers. Just a program note for you. Samara Cohen, CIO over at BlackRock, joining us a little bit later. In about 20 minutes from now, we'll discuss some of those numbers with BlackRock. Equity futures right now slightly negative on the S&P. Up next on the program, US growth as the next market risk.
People talk about a soft landing, but there is serious possibility of what people refer to as a no landing, that growth remains above potential, and inflation remains sticky.
And apparently that might be a problem for equity markets. That conversation is up next.